we're seeing is a change in sentiment around the tech and the AI trade.
AI has been sort of like a heat-seeking missile looking at different sectors.
There's definitely a lot of fears in the market right now, and not everything's really rational.
The uncertainty in AI suggests that that entire trade is going to remain challenging.
It feels like the bull market in AI disruption and hysteria has really taken off.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, finding some stability. Equity markets putting together 2 days without losses, and Treasury bond yields bouncing off the lows of the year as hawks at the Federal Reserve are pushing back against calls for rate cuts. The latest Fed minutes are due later this afternoon.
And to some degree, it's going to be ancient history, considering the fact that the Fed might look very different after April. Nonetheless, the fact that Austin Goolsbee of the Chicago Fed came out and said that he needed further evidence of inflation moving back toward 2% in order to cut rates. You heard a similar kind of thing from Fed Governor Barr. The idea that they do need to see more disinflation seems to cast some cold water over all of the rate cut bets from yesterday.
There wasn't much to take away from the last news conference with Chairman Powell, but one headline for me was just how much better the outlook was for him versus a month or so ago when that meeting took place. I wonder how much of that comes up in a minute, and I would pair that with what we heard from officials in the last 24 hours about the prospect of a higher neutral rate off the back of these developments in technology, and whether that's the angle that people start to run with going into a Kevin Walsh Fed later this year.
How many times can Fed officials say we have no clue without saying we have no clue? I mean, essentially, one person after another is like, we don't know, so we're just going to be paralyzed and stare into the headlights for a little while longer. This isn't like we're going to glean any kind of incredible insight from the Federal Reserve. I will just note, over the past 24 hours, we got inflation read CPI from the United Kingdom as well as from Canada. CPI in the United Kingdom at 3%, everyone's saying, hallelujah, let's cut rates. The idea that in Canada, 2.3%, hallelujah, let's cut rates. Suddenly, 3%, 2-point-something%, doesn't matter globally. That is enough, and I think that's tell.
3 is the new 2. Do you want to have some fun with the ECB?
I would love to have.
Let's do that. So in the Financial Times, we're waking up to this one. Christine Lagarde expected to leave the European Central Bank before her 8-year term as president expires in October 2027. This according to their reporting. The piece goes on, and here's the controversial piece. According to the person with knowledge of her thinking, Lagarde wants to enable outgoing French President Emmanuel Macron and the German Chancellor to find a new head for one of the EU's most important institutions.
She's worried about what's going to come next. And you're hearing this a little bit in other corners as well of European central banking. People want to get ahead of whatever is coming, which makes you wonder, well, what is coming then in terms of some sort of populist wave in the region? How do the existing central bankers preserve central bank independence? Is it their job? This is something that increasingly is going to come up.
So I'll start with the official response from the ECB, and then we'll get into it. The ECB is saying that President Lagarde is totally focused on her mission and has not taken any decision regarding the end of her term. OK, so we don't know if she's going to step down. We don't know why she's going to step down, if she steps down early. But let's take this at face value. It's a very odd position to take, to come out and defend central bank independence, just so long as the politicians you like are the ones that decide who replaces you. I think that is highly controversial and would set a very ugly precedent in years to come. Now, people might be comfortable with this now because they like Macron. Maybe they do, maybe they don't. How uncomfortable would they be if it was someone else in the seat and we saw central bankers stepping down? In fact, let's take it to the United States. Let's say it was President Trump that got to decide in France. Would we be happy with this decision? Of course people wouldn't be. Why are they comfortable with this? This is not good.
There is a feeling that central bank independence is as the status quo has determined that central bank independence is. And there is a feeling, as the Munich Security Committee came out with, that the world order is breaking down. And there are a number of people who would like to solidify the world order as it is now before it becomes a world order that is unknown. Whether it's ethical, whether this is a template, whether this will be looked back in time as institutions taking an overly political stance, we can determine that later. I do think it's notable in terms of girding down, battening down the hatches, trying to figure out what's going to come next. What are they afraid is going to come next, and how threatened they see central bank independence really as being?
You are a political beast, first and foremost, if you make that decision. Independence to one side, you are accountable still. You are still accountable, regardless of whether you are operationally independent from the government at the time. You are still accountable to the government. And I think the central bankers appear to have forgotten that, based on what we've seen in this and over the last few weeks.
I also saw reporting that she thought that it was a 5-year term and not a 7-year term.
I know, but that's lingered for a while.
I mean, that's, so maybe this whole conversation is for naught, and it really is just a misunderstanding.
As I said a little bit earlier, don't know if she'll step down early or why she'll step down early, but if you take that at face value, that would be highly controversial. And let's put it that way. Equity futures on the S&P 500 just about firmer by 0.5% on the S&P. Coming up this hour, Keith Lerner of Truist as the equity rally looks to get back on track. Jill Ford of Wells Fargo on why the IPO outlook remains strong. And Elyas Galou of Bank of America on growing capex concerns. We begin this hour with stocks rising as investors shake off the AI anxiety. Keith Lerner of Truist writing, there is a genuine fundamental reassessment underway. Added uncertainty points to higher volatility and a more bifurcated market. We remain overweight technology. Keith joins us now for more. Keith, welcome to the programme. How are you viewing the moves we've seen in the last month or so? Is this just a pure rotation, something you're comfortable with, or the kind of de-risking that makes you concerned?
Yeah, well, good morning to you both. It's been a really interesting market. The first thing I'll just point out this morning, Jonathan, if you look at the S&P 500, year to date, we're up 0.03%. So we really have seen this rotation. We have about 4 sectors that are up double digits, and then 4 sectors that are down. The way I'm looking at this, Jonathan, is yes, this is partly a rotation. Obviously, we all know that tech had a big run last year, and now we're rotating out to, partly cyclicals, and then we have staples on top of that. I also looked, and what's interesting is some of these sectors that are really up this year. If you look at materials and energy and real estate, and you throw staples in there as well, like the average market weight of these 5 sectors is around 3%. So I think it's a little bit of, again, rotation, a little bit of the cyclical side, and really just finding something that, that's been beaten up and some catch up. And maybe lastly is, there's obviously the concerns about the AI disruption as well, and people are seeking areas that are perceived to be less disrupted. Well, Keith, let's stay on the cyclical piece of this, because I think that's where it kind of gets confusing for people. If you look at the sector performance of the last week, the underperformance in financials and the banks on the S&P 500, and the outperformance in the defensive, say, staples and utilities, just how much of those moves reflect a so-called cyclical rotation? Yeah, no, it's that's why kind of going to this bifurcated market and a lot of different narratives. I think partly, if I think about the staples sector, first of all, what's driving that? Partly, the biggest individual stock in that sector is Walmart, and you can argue that's a quasi AI play that people think may be benefit, even though we know valuations have really moved up. The financials, I think, is a little curious. I think some of these banks had big moves towards the end of last year, but it is somewhat curious. I think part of the lagging there is we've seen interest rates come down, and those interest rates coming down have helped some of the defensive areas, like utilities, like real estate, as well. I will say, if I take a step back though, the technology sector, which has been hit this year, I mean, that sector in communications is about 40%. The earning trends in tech, over the last 4 months are by far the strongest of any sector. It's about 3 times the upward revisions relative to the S&P itself. So right now we're having, on one side, we're seeing, fear of disruption hurting tech. And then there's a lot of optimism about the economic uptick hurting some of these other areas as well. So it's kind of, like I said earlier, kind of a split market here.
So how much, Keith, are you taking a look at some of the actual earnings performance of, say, certain software names, certain technology names, and saying, this looks like a good bargain, we're going to load up?
Yeah, so the way our strategy, has evolved, last December, we did upgrade the cyclicals. We went overweight industrials, and we did keep our legacy overweight positions in tech and communication services, which obviously are down this year. So I mean, at this point, I do think that tech deserves the benefit of the doubt. We have to remember that the sector had really outperformed off the lows. Now, this kind of re-rating that we've seen has been pretty drastic. Back in October at the highs, the tech sector was trading for a PE multiple of about 32. That's now down to 24. And on a relative basis, that premium for tech relative to the broad market has moved down to about 12%. And relative to history, that's the lowest premium we've seen since 2020. So we still think at this point, tech deserves the benefit of the doubt. It is on an important technical level, the 200-day moving average. But all in all, I would say we're still sticking with tech. And I wouldn't be surprised if we start to see a little bit of move back into tech because it's already been disrupted as far as the valuations.
Keith, I've noticed that you've sighed a couple of times. You're not alone. There are a number of guests who've come on and just started sighing because it feels like a pretty exhausting market, and it feels like one that's not being driven by a cohesive narrative. Does this just feel like whack-a-mole to you in terms of the momentum trade?
It does. I mean, money's just moving from one area to the next. The narratives keep shifting, and that's why what I try to do in our work, our team tries to do, is just kind of zoom out. Focus on what are we actually seeing in difference in fundamental trends, earning trends. We obviously also follow the technical trends as well. But I think in this backdrop too, where the market's going from one area to the next, going back to simplicity and global diversification, within the U.S., outside, in different asset classes make a lot of sense. Because, I mean, look at the global markets. We have over 90% of global indices in uptrends. We are seeing, even though the S&P, as I mentioned, is flat, we're seeing small caps up 8%, mid caps up strong as well. So it's been actually a pretty good investing year underneath the hood. You just can't be overly concentrated just in the S&P 500 by itself.
Keith, when it comes to software, do you think there's going to be any scarring on the multiple, on the valuation of that cohort of stocks? The earnings remain robust for the year ahead, maybe several years out, but how scarred do you think the valuation story is going to be?
I think we've had a meaningful reset in valuations. I think it's going to be very tough to get back to any type of meaningful premium that we've been used to anytime soon, because even though the earnings are strong, even if CEOs come in and say, hey, our earnings are really strong, it's hard to disprove about what will happen in 3 or 4 or 5 years. And now that's what the market is focused on. That said, on a short-term basis, the software sector has underperformed the overall market by the most since 2000. So I do think this sector is deeply oversold, ripe for a bounce, but I don't expect it to be new leadership because of that kind of inability to disprove the narrative longer term. But again, I think it is oversold here on a shorter term basis.
That group of names on the S&P down by more than 20% so far year to date. Keith, it's good to see you. Keith Lerner of Truist there. Some scarring on multiples on valuations of those names in the months and years to come, maybe.
There's deep skepticism around margin compression. And frankly, the fact that you're seeing a number of software companies open their books early and say, hey, look under the skirt, check it out. It ain't so bad. And people still are sort of shrugging, gives you a sense of just how much skepticism there is out there.
It's an interesting phrase.
I'm butchering all sorts of phrases today.
Not heard that one before when it comes to companies.
It's going to be an exciting one today.
OK, all right. Looking forward to the next few hours. Stocks are positive by 0.5% on the S&P. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Good morning. Japan plans to invest $36 billion in U.S. oil, gas and critical minerals projects. It's the first part of that $550 billion commitment under the trade agreement struck with President Donald Trump. These investments include a natural gas plant in Ohio that the U.S. says will generate more than 9 gigawatts of power. Also, a deepwater oil export facility in the Gulf of Mexico. European Central Bank President Christine Lagarde is expected to step down from her role before her term ends in October of 2027. The Financial Times reporting Lagarde wants to leave before the French presidential election in April next year. The move would allow President Emmanuel Macron and German Chancellor Friedrich Merz to find her replacement together. Meta agreeing to deploy millions of NVIDIA processors over the next few years. The rollout will include products based on NVIDIA's current Blackwell generation and the forthcoming Vera Rubin AI accelerators. Meta also says it plans to rely on NVIDIA's Grace CPUs for the first time. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for the update. More from Vonnie later this hour. Up next on the programme, AI fatigue.
I think some of this is just AI fatigue. The uncertainty in AI suggests that that entire trade is going to remain challenging. And meanwhile, I think investors will continue to go basically from the virtual theme to the physical theme.
Up next, we'll catch up with Daniel Newman of the Futurum Group from New York City this morning. Good morning. Next up for this market later on this afternoon, minutes from the last Federal Reserve meeting. Look out for that a little bit later on today. Tomorrow we talked lots about this. Earnings from Walmart, the big report of the week ahead, that's for sure. Thursday morning, look out for that. Equities at the moment positive by 0.5% on the S&P 500. Very confusing market over the last few weeks, that's for sure. Tons of contradictions. Morgan Stanley's Mike Wilson writing, if AI is going to be highly disruptive, and far-reaching in terms of its effectiveness, doesn't that support the investment case for the infrastructure compute enablers? He also says if AI adoption is likely to lead to more job loss, isn't there a phase-in period where the natural attrition isn't replaced, efficiencies are realized, and margins expand? There is a bullish story in that.
And that's the sort of cycling through the different trends. And that's the reason why NVIDIA got a real pop yesterday. And there's a real question about how much NVIDIA is going to ultimately benefit, because if everyone's investing, well, what are they investing in? Guess what? It is what NVIDIA produces. And that's what increasing number of people are just getting around to.
Big earnings report next week from NVIDIA, and we'll catch up with Mike Wilson in about a week's time as well. The Nasdaq looks like this. Nasdaq futures higher by 0.6%. Under surveillance this morning. AI fatigue.
I think some of this is just AI fatigue. People are just totally tired of the AI concept. They don't know whether they're coming or going with it. The uncertainty in AI suggests that that entire trade is going to remain challenging. And meanwhile, I think investors will continue to go basically from the virtual theme to the physical theme.
So here's the latest this morning. Tech stocks bouncing back as dip buyers return to the battered AI trade. Joining us to discuss is Mandeep Singh of Bloomberg Intelligence. Mandeep, some stability in some important names as well, because Apple got caught up in this. Amazon did too. Are you seeing signs that maybe the worst of this is behind us?
Well, I think valuations, when you look at the software sector in general, were stretched prior to this drawdown. And, you know, a company like Palantir trading at 80 times sales, when Anthropic, which is growing, almost 10x in the past 12 months, you look at their private valuation, they were at a lower multiple. So some of those, I think, have corrected because of, what has happened. But there's no doubt that there is still uncertainty around how much of the CapEx increase is going to memory, which has really gone up so much because of the shortages, and how much is it for real capacity. And we don't know exactly, whether that 60% CapEx growth is going to translate into 50% plus additional capacity. And I think that's the concern in terms of how much are you going to get in terms of ROI and revenue growth versus how much is for component increases right now in that CapEx number.
Mandeep, to that point, do you think the regime has shifted? Do you think we're going to judge these companies differently? The metric is new, that the story of yesteryear is yesteryear, and that we're in a new place, a new phase.
Absolutely. I mean, token consumption, for example, is a new metric. And look, the market always looks for long-term revenue visibility. That's what is missing in the software sector right now. So if you can show that revenue visibility through that token consumption metric or RPO or backlog, some of the new metrics that are more tied to consumption of AI, I think that's where your multiples are going to re-rate. But until then, you will be in that penalty box.
Mandeep, thank you, sir. Mandeep Singh there of Bloomberg Intelligence. To build on that, Daniel Newman, the CEO of Futurum Group, a research advisory and intelligence firm, writing the following. This is not 2000. This is not an AI bubble bursting. What we're seeing is a healthy overdue rotation and a market demanding receipts. Daniel joins us now for more. Daniel, welcome to the programme. Let's talk about that last line, a market demanding receipts. Receipts from who? And is anybody getting a free pass?
I think the market wants to see receipts that this revenue generation that's supposed to come from all this AI CapEx investment is tangible, it's measurable, and it's real. You see companies like Meta that have performed well, not as well as I believe they should based on some of the concerns about Reality Labs and other things, but they're generating $60 billion plus of revenue because of the AI that they're able to add into their 3 billion eyeballs that spend time on their platforms every day. But then there's other companies across, say, the SaaS space, Jonathan, that have said, hey, we are being driven by agents, we are being driven by AI. And while their performance haven't necessarily dropped meaningfully, the ability to show clearly that AI is creating margin expansion, that it's creating net revenue growth or revenue expansion among its customers hasn't been as clear. And I think that's where you're starting to see that margin compression. And to your analyst's take just before, he's saying, hey, this re-rating, this token consumption, this is a real thing. And investors want to see it in the numbers.
Which company, Daniel, has the best ability to provide long-term visibility, which is essentially the receipts that you're talking about?
Yeah, I think there's a couple of aspects you have to look at. The first is going to be on the consumer space. And I mentioned it's the two big obvious ones to me, which is going to be Meta and Google. They're the ones spending big, and they're the ones that have the eyeballs, the attention, the users, and can say, hey, this is how AI is inflecting our business. The enterprise side is a lot more interesting. You know, Palantir has been the driver, but that huge multiple and some of the opaqueness of how exactly their business is done still creates concerns, although they have that great retail momentum. I'm looking at names like Salesforce and ServiceNow, though. I'm looking at those companies that have said, hey, AI is not causing a problem for our business. In fact, it's accelerating it. ServiceNow showed a rule of, I believe, 55 coming out of that last quarter's guide. And you know, people are saying, hey, this needs to be trading at 50% lower. But if Bill McDermott and the team can actually show, hey, we've got stronger business, AI is creating greater multiple expansion or margin expansion for us, I think the market's going to take a breath and say, maybe we got this wrong. In the end, our belief at Futurum is that it will be collaborations between labs like Anthropic and OpenAI and companies like Salesforce, Workday, ServiceNow. It's not going to be a replacement. And if it is a replacement, you're talking many, many years into the future.
So, Daniel, I've gone down this rabbit hole in my free time looking at some of the debates on Twitter, X, about what actually is a moat around software and what isn't a moat around software, what actually creates an undisruptible business model. Do you have a clear sense of fact from fiction of why a Salesforce type of company is undisruptible from AI and potentially is a bigger beneficiary from it?
Well, first of all, I think it's an error for any company to say they are undisruptible. I think we've seen in just such a short period of time the incredible innovation that companies like Anthropic have been able to deliver with co-work, with code. Having said that, I think it really comes down to what I call the rules and the rails of doing business and operating a business. There is so much everyday requirement to update the compliance, the government, the transactability that these companies have. So if you want to be able to do business in hundreds of different countries, to be able to transact, to be able to move money, to be able to manage private and proprietary data, the ability to just drop all that into a database and say Anthropic or Claude or ChatGPT, run my business. It's a dream. If you're building a native business from the digital ground up, there is going to be more and more disruption. And I do think there are certain companies that came out over the last 5 years that were merely features that get consolidated into some of these bigger platforms. But I look at the rules and the rails. That's how I like to describe it. I think it's around compliance, governance, security, and whether or not businesses want to be managing and updating the software that run their operations every single day. Because if they're vibe coding their platforms, even if they're able to build it, they're still going to have to manage it. And I think that's one of the big moats that software technology companies have to maintain their businesses.
Lisa, when did X become the destination to dump 2,000-word posts? When did that happen?
I'm not sure, but I'm really digging it.
Is this Bill Ackman's fault?
You think that, these are all bots out there that are arguing with each other, and I'm there for it. I actually really want to read. If you are a bot and you're writing an interesting argument, I am there reading it. Love this.
I think some of them are 2,000-word commercials dressed up as analysis.
I think that's
correct. What I said to you yesterday.
I think that's absolutely correct, and I think we've seen that borne out. I mean, guess who's raising money? Well, guess what? Some of the platforms that are going to be the most disrupting of all of these other technologies.
Daniel, how much of this is just marketing and commercials from some big players who might be coming public later this year?
Are you talking about the long X post forum?
I'm talking about some people with a bit of self-interest in that, yeah. I'm thinking about Anthropic with some of the headlines they've made, the Microsoft AI chief in the FT. There's been a few.
Yeah, I mean, look, if I have a platform, I love X. And like Lisa, I spend a lot of time there. It's the real-time fire hose. It's where people bring their instant real-time analysis and reaction. Of course, they're doing some marketing and advertising. Right now, whether it's Dario or whether it's Sam or others, they have this platform to be able to tell the world what they think is going to happen. And the world is listening because every day they're seeing these new and exciting technologies come out and they're disrupting and changing the way we work. And whether or not it's creating a technical correction or the market is pulling back or there's some AI fatigue, I think anybody that's using this stuff every day can see how transformative it is. If you spend just a few hours playing in Claude or in any of these tools, you can't have any other reaction than this is going to change the world. How quickly it does it and how quickly it changes businesses, I think that's what the traders are betting on. But if you're a long-term investor, this AI trade is very real. And these are not just commercials. This is the most transformative trend that I believe we will see in our lifetimes.
Daniel, it's good to see you. Thank you, sir. Daniel Newman there of the Futurum Group. Just bear in mind they've always got something to sell. That's all I'm saying.
My 16-year-old is sold. Mom, Claude's amazing.
Sure, there you go.
It's going to reorder my desktop. Can I get a subscription?
He's ready to pay.
He's ready to pay,
yes.
with whose credit card?
You've got to pay.
Yes.
Here are the scores this morning. Equities positive by 0.5% on the S&P 500. The good way of framing the last 2 days is 2 days and no losses. I guess the more negative way is to say that they are pretty minimal gains on the S&P on Friday and through Tuesday. This morning, a bounce on tech on the Nasdaq 100 up by 0.6%. The good news is we ended a 9-day streak of declines for Amazon in yesterday's session, and Apple, following a 7% drop in just 2 days, managed to rally for its best day in a couple of weeks.
I'm going to take the glass half full approach.
Please do.
I think that it is 2 days of gains. We've actually staved off some of the losses, and we've actually engaged with a new type of rotation. Yesterday, you were beaten up on Walmart and the multiples. Well, guess what? Walmart fell almost 4%, so thank you, John. But it does seem like people are maybe going back to the AI names in this sort of revolving game of whack-a-mole. That does seem to be this massive churn under the hood, but hasn't dragged down the overlying index.
Going into earnings from Walmart tomorrow morning, so look out for that. Switch up the board and get to the bond market. 2s, 10s and 30s. Some hawkish Fed speak, helping to keep the 2-year yield north of 340. Yields up again by a single basis point, bouncing off the lowest level we've seen since September 2022. A chorus of hawks from the Federal Reserve making themselves heard.
Yeah, Goolsbee and Barr in particular talking about how they want to stay on hold. And then, of course, Mary Daly of the San Francisco Fed talking about how we have no clue about how AI is really going to transform both the benchmark rate as well as, frankly, employment prospects. And they're carefully watching this. They have no clue. They're going to change as the data changes, and the data is messy and noisy, and everybody can read a different story. So it seems like if there is a data print that actually does confirm one AI trend or another deterioration in the economy, this narrative shifts on its head in one day.
Just like that. I'm totally there with you. We've got this really good, decent story to tell about the outlook. One data point that undermines it and everything just flips. Just like that.
It feels like this is two teams that are very evenly matched on the field, and they both have, the quarterback, and they both have the forwards, and they're trying to come together, and it just takes that one play that's really going to make a difference.
We're doing sports now. I was going to let you run with that. Going to keep it going? No, I don't fancy it. I don't either, to be honest with you. 2s at the moment, 344. 10s at 4.06%, with some movers going into the open and about 3 hours away. Here's Yahara with more. Hey, Yahara.
Hi, John. Meta is going all in on NVIDIA. The company says it will deploy millions of NVIDIA AI chips over the next few years as it expands its partnership. The rollout will include NVIDIA's latest Blackwell systems. And for the first time, Meta will use NVIDIA CPUs in standalone servers. We crunched the number on the deal, and it could be worth more than $16 billion easily. So shares of both companies up in the pre-market. But the win for NVIDIA is putting pressure on the competition. Take a look at AMD shares. They are falling 1.8% as the AI gap grows even wider between the two chip maker. Arista Networks down 3.2% on fears that NVIDIA is pushing further into networking with one of Arista's prime customers, Meta. And we end on the cybersecurity firm Palo Alto Networks. Shares are plunging 6.6% after the company cut its profit outlook. This is a firm that has been spending aggressively on acquisitions. It even announced one yesterday, but that is starting to weigh on profits. So that is doing little to ease concerns on a company that had been caught up in the software and cybersecurity sell-off over the past few weeks, with shares down 9% year to date heading into the earnings print yesterday. John?
Yahara, thank you. More from Yahara in the next hour. On our radar this morning, Japan launching its trade pact with the US, investing up to $36 billion in American energy and critical mineral projects. The deal including a new natural gas plant in Ohio, aiming to provide more than 9 gigawatts of power. Elsewhere, Anthropic launching its second major AI model in just under 2 weeks. The startup saying the new model features advanced computer capabilities and superior coding power. Software stocks taking a hit on the news, closing Tuesday's session in the red. And finally, ECB President Christine Lagarde will likely step down before her term ends on October 2027. The FT reporting Lagarde wants to leave before the French presidential election next April so that Macron and the German Chancellor can choose her replacement.
So you were talking earlier about how this essentially is a political act, and this really is choosing the current administration over whatever could be the future administration, and it really kind of throws central banks into the crosshairs of political accusations. That's a fair argument. I think that there is a bigger point here, which is increasingly they are political instruments, and that whether the central banks want to or not, because of the level of deficits, because of the focus on borrowing costs, because of the focus on interest payments, they are increasingly becoming political. And all of their actions will be looked through that lens, whether they mean it that way or whether she just thought that it was a 5-year term instead of an 8-year term.
Well, that's a separate issue, isn't it? Particularly the last point. This has always lingered around the Lagarde ECB.
Yes.
It's been problematic for some time. I'll try and repeat and clarify what I said a little bit earlier so it comes across with maybe less anger. The ECB president is signing up for an 8-year term, whether she thought it was 5 or 8, beside the point. I don't know if she's going to step down early or why she would step down. But if she steps down to allow Macron to choose her successor, that is political. And it makes it very, very difficult for your successor to defend central bank independence against what comes next, when you've stepped down because you want your politician friends to choose who replaces you. I think that that act undermines everything you've stood for over the last month or so, particularly when you've defended central bank independence in the face of what's happening here, abroad, overseas, when you haven't got your own house in order at home. When it comes to Christine Lagarde and the ECB, you can talk about how she's operated. I think that's all separate. Just leave that to one side. I'm a massive advocate of central bank independence. I think most people watching this programme are too. And I would hate to see an act that would undermine it and make it difficult for people to defend it in the years to come. And something like that, and I have no idea if it happens or not, but something like that could establish a pretty ugly precedent in years to come.
It's a great point. I'm not going to argue with that. It's a great point. And increasingly, how much do different central bankers have to really be aware of how they preserve central bank independence by setting a precedent, even if it seems like the sands are shifting to such a degree that they really can't foresee how central bank independence is going to be preserved in the future. That's not their job. Right now, it's to really make sure that they do the right thing and set a certain precedent.
Let's see what happens also. You know, the ECB are denying much of this in all the reports we've seen as well. Let's turn back to markets. Investors gearing up for what could be a historic year for IPOs, with SpaceX, OpenAI and Anthropic among those preparing to debut. Jill Ford, the co-head of equity capital markets at Wells Fargo, writing, AI is creating disruption in capital markets, but also creating opportunity and pulling forward others that will be in favour. Jill joins us now for more. Jill, good morning.
Good morning.
Can you just frame for us the kind of year we might have for IPOs and how historic the next 12 months might be?
Well, one thing I know is I don't know. It's been obviously a crazy last couple of weeks that we've all seen in the overall markets. What that has done is forced active fund managers to really cull through their portfolios line by line, figure out what could be disrupted, what could not. That causes distraction against the capital markets, but it's also a reflection of where they want to put their money with respect to the new issue markets and IPOs in particular. We've seen some examples of that. A couple of deals got pulled altogether that had been come out and launched that never made it to the tape, even after some pretty heavy restructuring with respect to size and price and valuation. We've also seen some others that we thought were 27 IPOs now start to re-engage in conversation about coming out here in 26.
We're all focused on the beasts, OpenAI, Anthropic, SpaceX. These companies are massive. When you compare the kind of companies that listed 20 years ago to the ones we might see in 2026, just how much has this market changed?
Oh, no question. This is completely different than anything we've ever seen. Companies of this size, of this maturity, of this scale, would be public for many years by now in the past. And part of that has been the proliferation of a really deep private market so that they have access to capital. But I also think that they did well to stay as private companies and to be able to grow in the way that they wanted to grow without being under the microscope of being a public company. Now that they're coming, however, it's going to be a big basketball in the bathtub, right? This is going to create an unprecedented amount of supply because not just are they big, but the capital needs that they have are big as well.
Are investors prepared for it? Are they going to have to sell assets in order to play into it? I mean, how disruptive to valuations in other areas and potentially other IPOs that could be coming at that time would an OpenAI or an Anthropic's IPO look like?
I would say yes and no. There's no question with the amount of supply coming into the market, people will have to sell certain positions that they own to make room and to create the dry powder. However, if you look at particularly some of the bigger hedge funds, some of the bigger mutual funds, they already own some of these companies in the private sphere as crossover investors. So their amount of exposure is not zero. And we'll see that demand come in for the supply, I think, come in some of the more non-traditional new issue buyer cohorts, which would be family offices, sovereign wealth funds, pension funds, retail, for example. All of these will come in and help sop up some of the supply, as well as the fact that they're sitting in large cap funds, right? These are mega cap companies. The traditional buyers of small and medium, size IPOs, which is the traditional IPO, they'll be unaffected. So there will be some, I think, changing of rotating out of positions to make room, but I don't think it's going to be as draconian as people think.
So every morning when I come in and I tell John about another 2,000-word article that I've read in X, he looks at me and he says, roadshow, roadshow, guess what they're doing? They're all preparing for something to come out.
It sounds like a roadshow.
Right, well, it's working, right? I mean, you've got the expectations really high for Anthropic. They come out with a new press release and everybody presses sell on their 5 favorite software stocks. I'm just wondering, does that mean that they're all going to expedite their IPOs? I mean, this is peak froth for these names, peak speculation. Do you see it kind of forward, accelerating the forward calendar a bit?
Again, these are massive companies. They don't need to do anything, right? They have access to capital. They eventually will have a growth plan that involves being a public company. But they're going to take their time and they're going to do it the right way. They're not subject to the vagaries of, is the software, index up 20%, down 20%? They're going to do what they need to do for their individual businesses. That's why they become so incredibly valuable over time. And so the dialogue that's going on right now is the market fertile? Do investors have their wallets open? What kind of valuation could I get? And they're weighing it against the path of staying private longer. And I think, like I said, those conversations have become more intense. They've become more intentional. You can't just turn it on a dime. There's a very long process that has to happen with respect to testing the waters and making sure you've done everything correct with the SEC. And so they're going to go along their path and keep their options open. And if the markets stay the way that they're staying in terms of the froth that you're talking about, I'm guessing some of them will come out in 26, and even some that might have considered coming out in 27, accelerating those plans. But again, it's not accelerating it where you're turning on a dime. It's really big ships that they're moving quite nuancedly.
Gil, let's build on that. If this is a roadshow, it's a highly disruptive one, and there's a phrase you used: is the market fertile? It might be for them, but are they making it infertile for other participants in the market? So if you're a software company right now, they're making it very, very difficult to go public. Is this a halo effect on tech stocks, or do you find this a disruptive moment for companies coming to market?
The way that I look at it is not all software stocks are created equal. There are some that will be disadvantaged, right? There are some actually that we think will pull forward. Cybersecurity, infrastructure, people who own the data, if you will. There are a whole slew of other companies in the fintech world, in the consumer retail world, in the boring, you're going to have Jim Zelter on in half an hour or so. Think about all the boring real asset companies that sit within that portfolio of that amazing private equity firm. These are flavors that investors, not every investor is a tech investor. Not every investor has that mandate or wants to be only focused on SpaceX and Anthropic. There are a lot of really interesting real asset companies that are not very disruptable by AI, which will come to market this year. And you've seen some of them come already, and the pipeline is still growing and still there. I don't think it disrupts everything. It doesn't suck all the air out of the room, but it will be an exciting time, and it will put all eyes on the new issue markets.
Given developments more recently, I think that's the biggest compliment you could give Jim and the team at Apollo. That it's a boring business at the moment.
I mean, ultimately, that might be the argument that we get. By the way, fantastic job promoting our next guest. Coming up next, you should have put a sort of thumbnail over this. But look, this is sort of the idea of responsibility and moats versus the idea of disruptability, and how do you sort of just delineate at a time of rumor?
Jim Zelter, Apollo, 20 minutes away. Jill, good to see you. Thank you. Jill Ford there of Wells Fargo. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Back with us is Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. UK inflation dropping to its lowest level since March of 2025, with consumer prices rising 3% in January from a year ago. Lower petrol prices dragged on inflation. Airfares and food also put downward pressure on CPI, offsetting higher hotel costs. Warner Brothers Discovery agreeing to reopen buyout negotiations with Paramount Skydance. Paramount will be allowed to make a best and final offer after indicating it would raise its bid by at least $1 per share to $31 per share. Warner Brothers agreed in December to sell most of its business to Netflix for $27.75 a share. Anthropic releasing a new AI model that it says is better at using people's computers in increasingly complex ways. Claude Sonnet 4.6 can perform multi-step actions on a computer, such as filling out web forms and coordinating information across several browser tabs. Anthropic also says the model is more resilient against security threats. And that is your Bloomberg Brief. John.
We're going to wipe out all jobs in 18 months. Have you tried Claude Sonnet 4.6?
I haven't, but you know what? Maybe I should. I should go sign up for it right now.
People will.
Honestly, I tried to click on Claude, like buy me now.
Right.
And Bloomberg said, not allowed.
Oh, you tried to do that here internally.
Yeah.
There you go. There you go.
Yeah.
I'm sure. Up next on the program, AI CapEx concerns.
Today, the dissonance is around AI. The market, efficiently and rightfully so, is taking a breather on spending and waiting for the adoption phase.
A conversation up next with Elyas Galou of Bank of America from New York City. You're watching Bloomberg TV. Stocks are positive by 0.4% on the S&P 500, on the Nasdaq up by 0.5, on the Russell this morning up by 0.1. An update on the bond market for you. Yields bouncing off the lows of the year in the last 24 hours, up again this morning by a basis point, up a single basis point at the front end of the curve, and on 10s as well, the 10-year at 4.0674%. And the surveillance this morning, AI CapEx concerns.
It feels like the S&P bull market has paused, and the bull market in AI disruption and hysteria has really taken off. Today, the dissonance is around AI. You have both market discounting AI counterparty risk in terms of the model makers and software. The market, efficiently and rightfully so, is taking a breather on spending and waiting for the adoption phase.
So here's the latest this morning. Bank of America's February Fund Manager Survey showing investors are the most bullish since 2021. 35% of investors saying CapEx, though, is too hot. And a record number of corporations are over-investing. Joining us now is Elyas Galou of Bank of America. Elyas, just give us the chart, because it's a great chart in the piece you put out in the last 24 hours of what it looks like when you've asked that question over the last 20 years or so, how people have responded and how quickly that story has changed.
John, I think, it was one of the biggest game changer of the past 20 years. Suddenly the catalyst of this bull market, AI CapEx, and the foundation of this bull market, the tech sector, which has led the gains in the S&P 500 pretty much since the GFC. Well, investors are now suddenly realizing that the business model of this leader, the tech sector, is shifting. It used to be an asset-light model, which is now shifting into an asset-heavy model. And this is why FMS investors, the majority of them, are saying right now the most important is that the CFO, the CEOs of the tech companies slow down CapEx, because we are not sure that the productivity gains from AI will be as great as the price and the valuations of the equity sector are implying.
We followed this survey for many years, Elyas, and when I would go to the most crowded trades, number one almost repeatedly for so long, so many years, was long US tech. Are those CapEx concerns upending what was once a very consensus trade?
Clearly, pretty much since 2023, Long Magnificent 7 has remained the most crowded trade. Over the past year, it was, it's been co-leader with Long Gold, but really Long Mag 7 has been the most crowded trade of this bull market that started in October 2022. Now, I think what matters most is the direction of the balance sheet of the tech sector. And investors right now, they're not worried about AI. They are still very much convinced that AI will deliver the kind of productivity gains that will sustainably boost EPS, that will sustainably boost economic growth without lifting inflation. But it's just that they just want CapEx to slow down a bit in order for the balance sheet to remain immaculate and sustainable.
Elyas, this feels like a group of people who are very worried, but still investing hand over foot, because you look at the optimism that is one of the most bullish in recent memory in terms of just the overall sentiment. You still have long big tech as one of the biggest trades and one of the most overweight trades. And people still see profits that will grow by to the highest levels or the fastest pace going back 4.5 years because of AI. So which is it? Are they over-investing? Or frankly, are people looking for the profits and the gains and they're just worried and they're wringing their hands because they want to feel different?
Sure. Look, it's still the middle of the summer here in the northern hemisphere, Lisa, as you know. But clearly, this was the hottest FMS survey of the past 5 years, and that is because investors are so bullish on profit expectations. The most optimistic on EPS growth in 5 years, but they are also very bullish about the macro. I think what the one metric that struck me this month is the that there is an absolute majority of respondents who believe that there's going to be a global economic no landing, over 52%. And this is something unseen since we started asking this question in 2023. So investors are very bullish about the global macro, but this exuberant sentiment is now solely based on one pillar, and that is the AI pillar. So the foundation right now is fragile, because if the AI pillar starts to tumble, it's the entire positioning and the entire sentiment that will follow. And this is why we've seen the volatility in the assets that really concentrated the froth at the end of 2025. And this volatility is going to remain until we see a game changer when it comes to AI capex, and we think this game changer will probably happen when one of the big hyperscaler announced not a capex cut, but a slowdown versus the expectations that was set only a few weeks ago.
Certainly haven't seen that in the last month. Elyas, I wanted to squeeze this in. The third most crowded trade, short the US dollar. I want your judgment now, not what's in the survey. Would you lean against that, given what you're seeing play out and how offside the market is at the moment?
It depends on the horizon. Tactically, adding a little bit to your dollar positions makes sense because, as you said, John, being the position on the dollar remains extremely underweight, but it has remained very underweight pretty much since post-Liberation Day last year, since April 2025. So investors right now, the long-term view is that this is a market that will be driven by AI productivity gains, but they also are looking at the fundamentals of US fiscal policy and the balance sheet of the US government, which is not improving. When the CBO released their forecast last week, if you remember, they projected that the US national debt would rise by $2.5 trillion every year in the next 10 years. And John, the US government will pay over the next 10 years an amount of interest payment that is pretty much the size of the European economy. So the investors remain laser focused on this fundamental of the US government balance sheet. So they remain very much underweight bonds and underweight the dollar. Now, the big question is whether this new Fed policy is good or bad for the dollar. We ask this question, and most of FMS participants believe that a wash Federal Reserve means higher bond yields and lower US dollar.
We'll see. Elyas, thank you. Elyas Galou there of Bank of America. Thank you, sir. This from SocGen. Dollar bears are skiing uphill at the moment. Kick juice just yesterday.
So far, everyone is on the same side, which is that the dollar is going to weaken. So what happens when it strengthens? After Kevin Warsh got in and then had some sort of things to say that were a little bit more hawkish, well, that's part of what flipped everything on its head. So how much is this a levered trade on the other side?
Did you see the Norwegian skiing uphill? Have you seen those pictures? I
obsessively watch that again and again.
Absolute beast.
Another version of humanity that I aspire to.
I think he's faster than me going downhill, going uphill.
Absolutely incredible. I mean, I just was getting out of breath watching it, thinking I think I need to eat something.
Beast, absolute machine. The second hour of Bloomberg Surveillance. Up next, Jim Zelter of Apollo.
We do expect to see some growth surprises.
Long term, I would be a little bit cautious about this rally in the 10-year.
The risk is towards fewer cuts, not more cuts, if the economy holds up.
Fed on a go-forward basis is probably in more of a reactive mode.
The real debate this year on the Fed is where neutral policy is going to be.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. The price action shaping up as follows. Equity futures on the S&P up by 0.4%, adding to some muted gains over the previous 2 days. On the Nasdaq, up by 0.5%. In the bond market, a bounce continues, a bounce off the year-to-date lows on a 10-year Treasury yield. We're up by a single basis point at 4.06%.
Do you see this as really having anything to do with the hawkish speak from a couple of Fed members yesterday?
At the front end a little bit.
Maybe. Okay, because people are looking for direction, and we're going to get Fed minutes that are about as stale as an old cookie. And you're looking at this and you're thinking, okay, what guidance can they give us? Given the fact that we've got messy data, they don't understand AI's ramifications, and they're coming out again and again and saying, we're watching everything, we're not sure, we need to see more progress. How high is the bar to have another data point that really moves the needle on this? I'm not sure we have a good understanding of that.
So let's take the data just as an exercise and compare it to how the market has responded to it. And I would conclude the following, that there is a bull case, but it's a pretty low conviction one. Because every time we get a data point that counters the narrative, you see the move at the front end of the curve and yields drop. We put more weight on a softer than expected CPI than we did on a stronger than expected payrolls and a really decent ISM manufacturing. And they're two pretty strong pillars to communicate a story that the year ahead is going to be decent for growth. But you get any kind of sign that that's undermined by whatever, challenger job cuts, Tier 2, Tier 3 data, and you'll start to move the other way. And I think that's notable.
Yeah, and people increasingly are poking holes, though, in that jobs report, saying that it wasn't as strong as it looks, and a lot of people saying it's affected by seasonals, it will be downwardly revised, et cetera, et cetera. I think you're raising the right point. How much is now the new emphasis on disinflation? And what is considered good disinflation? I keep going back to the fact that we got the UK coming out and saying they only have a 3% CPI rate year over year. Guess what? We can cut rates. In Canada, 2.3% victory. At what point are we looking at an inflationary environment globally that's just accepted by central banks and frankly embraced as long as it doesn't have higher than a 4 handle?
Show me your unemployment rate at the same time. Once you get to a 5 handle, you've got a bit of a problem. The UK's got a bit of a problem. There's the itch there to cut interest rates, and anything around 2 to 3 is probably going to give them the space to get it done.
And this is the reason why the ramifications of the artificial intelligence and how it gets adopted throughout the economy really matters. There is an existential fear right now among policymakers, around businessmen. What is the effect going to be on human employment, and how much does that lead to this jobless growth that we continue to see that really leaves people in a bad shape?
Yeah, it would be easy to blame AI in the UK. They've got a tax problem. If you tax jobs, you'll get less of them. It's very simple. You put up payrolls taxes, you're going to make it more expensive to hire people. You put up the minimum wage, you're going to make it more expensive to hire people. Who aren't being hired? Young people in the United Kingdom. You've got a policy issue. You can't just blame tech and AI.
Yeah, and who are those young people? Predominantly men. I mean, the fact that 1 in 5 men in the United Kingdom are unemployed, who are between the ages of 18 to 24, speaks of a new era in terms of what the political zeitgeist might look like.
If you make it more expensive to hire people, what will companies do? They'll invest in tech. That's what companies are going to do.
Yeah.
Equity futures right now in the S&P 500 up by 0.5%. Coming up this hour, we'll catch up with Jim Zelter of Apollo as equities find their footing. Mitchell Green of Lead Edge Capital will join us, saying enterprise software is far from obsolete. And Oliver Chen of TD Cowen as Walmart eyes new highs ahead of earnings. We begin this hour with stocks stabilizing following a software-led sell-off. Jim Zelter, the Apollo Global Management President, saying the firm maintains one of the leanest software positions in the sector. I'm pleased to say that Jim joins us now for more. Jim, good morning. Good to see you.
Good morning, John. Always good to see you and Lisa. Thank you for being...
What do you think we're going to cover this morning? Probably software, right?
I think you probably might ask that question, I suspect.
I want to pick up on this quote from Mark Rowan, your colleague, good friend. In our PE business, our software exposure rounds to 0. In our Athene balance sheet, our software exposure rounds closer to 0 than to 1. That was on the call in the last week. Can you frame for us your deployment into software versus maybe your competitors and why you weren't as big, as aggressive as others have been?
Well, I think the answer is you need to take a step back in the whole evolution of the role of private credit. And as we've talked about on the show before, the non-investment grade portion, which is really the area where PE sponsors look for financing, that's the area where software tech, healthcare tech is around 40% of the marketplace. And we just used as a principal investor in that area, we had a view that there was a greater degree of potential disruption over time in those business models, and a far greater focus for us is on the investment grade side portion of the private credit world. So, you know, I've been in the business for 41 years. The S&P 500, since I got in the business in 1985, 373 companies have moved out of the S&P because of disruption in mergers and acquisitions. And I think every decade there's more evolution out of the S&P 500. So I just think that it wasn't that we were smarter, it's just that when you have a disciplined approach on value, when you have a disciplined approach on how you want to underwrite, there's a tremendous amount of wonderful companies out there. But when we think about equity at the bottom of a levered balance sheet or a levered capital structure, there's just risks that we thought were not prudent for our style of investing.
Management teams will often say they don't follow the stock that closely, but your stock has got caught up in the sell-off. And I'm wondering what your interpretation of that actually is, why you think that's happening, and what investors are telling you about how your name trades at the moment in public markets.
You know, I think as the evolution of the markets and the role of private credit has really continued to evolve and play a major role in the financing markets the last 3 to 5 years in particular, we've been a massive beneficiary of that. We've brought our retirement services, lower cost capital to be a solution provider. We've had tremendous growth in our company and every part of our company the last 4 or 5 years. And I think that the great thing about capitalism is if there's concerns, the market reacts really, really quickly. Price activity, price action in the equity market is instantaneous, as we've seen in the last couple of months. And I think that there are some great companies in our sector that have been victims of let's move on and let's pare down positions in periods of uncertainty. So there's nothing fundamentally that investors have told us that there's concern about our company or sectors, but there are certainly concerns about the growth of private credit in aggregate. And we've been pretty consistent for our stock. Long term, to create the value that we believe it will, we're going to need to go through a credit cycle. And at some point in time, it's been, if you really go back, it's really been 07, 09 since there's been a deep credit cycle. We're supremely confident of our ability to navigate that credit cycle very, very well, especially with the predominance of our IG exposure. And when we do that, I think that the marketplace will see the great benefit of our franchise. But I'll also add, I'll just pivot for 1 second. You know, prior to earnings, we just got back from Japan. We took 200 partners over to Japan for a better part of a week. We do it every 2 years. And when you think about the things that we're involved with retirement solutions, helping investment grade companies evolve, global growth of economies that are in transition periods, Japan was an amazing place for us to get that strategy. So a lot of answers there, but it's a very exciting time for our business.
I heard that there are certain actors who are bad actors in the space that are dragging you down. That's kind of what I heard. I mean, is that correct? I mean, is that sort of how you see this scenario, given the fact that there will be a credit cycle and some of them are going to get washed out?
I think what a cycle does is a cycle always allows for dispersion of returns. And again, I think that there's a handful of us that are public. We all have very different strategies. We've all really leaned into either real estate, we've really leaned into credit, we've leaned into Asian equity, whatever it may be. Our business is a bit different because of the Athene angle and the aspects of our retirement services platform and the fact that we act as a principal. So there's a variety of different strategies out there. We're convinced that ours over time, with the changing winds of finance, with the demands from technology, energy transition, that our model will be a wonderful model in that. And others who have invested in areas which might have been interesting at a point in time with the information you had at that time, you know, we'll see how those do. But again, I'm not close enough to other software portfolios to see the robust nature, but certainly they're going to go through a period of economic disruption. And again, all the guests on your show talk about AI with regard to data and chips and energy. There's a second and third and fourth derivative of this will come out over the next 3 to 5 years about the real return on invested capital, what it does for employment, what it does for white-collar jobs, what it does for a lot of areas. And I think it plays into another big theme, which we've talked about on the show, is that the last 15, 18 years, it's been monetary policy, monetary policy. It's all about monetary policy. Because a lot of government officials in the world have taken a step back and let the monetary authorities take the lead. The reality is this is a time for a lot of fiscal activity to be really dealt with. You talked about the UK with taxes and minimum wages. This is the time. Monetary policy can only do so much. Yeah. You need to have good fiscal policy, really be thoughtful about long-term retirement solutions, long-term budget issues, and that can't be led by the monetary authorities.
Jim, there's a lot to unpack there. I am curious, 2024, you were talking about the golden era for private credit and for credit in general. I wonder if there's been a shift, given some of the difference in fiscal spending and the shift away from monetary policy, where that era is over. And now it's shifting to things like insurance. It's shifting to infrastructure. And frankly, it's harder to raise money for private credit. There aren't as many opportunities right now because we might be heading into a credit cycle. And it seems like the opportunities are elsewhere.
Yeah, I take a much longer view of the role of credit. And I think, if you take a step back as usual, look at bank earnings in the first quarter. They were very, very strong. The evolution of finance in the U.S., it's no surprise that the economic engine of the U.S. has been leading the world. I think the evolution of the capital markets and the role of private credits had a big impact on that. And again, I sort of turn my lens to the broader investment grade portion, which we've been as active on the issuance and the partner activities of our business than we've been in years. The non-investment grade, the sponsor-led business, is going to go through some degree of turbulence. There's lots of questions about the private equity asset class and the monetization cycle and the IPO cycle. But don't be confused. The demands of capital by many of these companies, whether some of the Mag 7, not Apple, but the other ones, and many other companies, the demands on credit and the demands for capital to build out the vision of what they want to do is voracious. Look what's happened in the last couple of weeks in the IG market with a couple of large issuers, whether it's Alphabet and others. There's a voracious demand for capital, and I think many investors around the globe are saying, I actually have allocated quite a bit to corporate credit. How do I allocate to asset-based finance? How do I allocate to other IG strategies when IG indexes are virtually at all-time highs, and I'm looking to make not 400 over, but I'm looking to make 150, 200 over with the Treasury in the low fours? There's voracious demand for that around the globe.
I've heard you use this phrase, the pebbles versus the boulders.
Yeah.
Could you just communicate that to our audience, what you mean by the pebbles versus the boulders, and what we're being distracted by right now and what we should focus on?
Well, I think, in our case, we are a company that when we announced our earnings last week, we were a $930 billion or plus or minus in assets. We've grown tremendously over the 20 years that I've been there. And for us to really have an impact on our enterprise, we need to focus on large river opportunities. And when I think about the amount of software in the non-investment grade world, it's a plus or minus $300-400 billion opportunity set. There will be some winners and losers there. We're not spending a tremendous amount of time thinking about the winners or losers there. I'm thinking about how do I become a retirement solutions provider in Australia and Japan. Those are boulders. The software, it's a good conversation. Will we be talking about enterprise software and the impact on defaults in 12 to 18 months? I think there will be some conversations, but I don't think it'll be the central conversation on this show.
Jim, you're going to stick with us. Jim Zelter of Apollo Global Management. The president of Apollo is going to be sticking with us. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Meta agreeing to deploy millions of NVIDIA processors over the next few years. The rollout will include products based on NVIDIA's current Blackwell generation and the forthcoming Vera Rubin AI accelerators. Meta also says it plans to rely on NVIDIA's Grace CPUs for the first time. Apple is accelerating the development of 3 new wearable devices as part of a shift towards AI-powered hardware. Sources telling us here at Bloomberg the company is working on smart glasses, as well as AirPods and a pendant equipped with cameras. Apple is said to be eyeing a 2027 release for the smart glasses, while the AirPods and pendant could be released as early as this year. The US and Iran are making progress in nuclear talks held in Geneva under the threat of American military strikes. Sources telling us here at Bloomberg Iran's negotiators are due to return in 2 weeks with a new proposal. Earlier, Iran said it reached a general agreement with the US on a nuclear deal that would lift sanctions and ease the risk of military conflict. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie later this hour. Up next on the program, Japan betting big on the United States.
They just signed the largest trade deal in history. I think maybe the largest deal in history with Japan. We worked on it long and hard, and it's a great deal for everybody. We're doing things that have never been done in this country before, and our country is becoming very rich again.
Up next, we'll catch up with Bloomberg's Tyler Kendo, and you'll hear more from Apollo's Jim Zelter from New York City this morning. Good morning. From New York City, welcome back to the program. Equity futures positive by 0.5% on the S&P, bouncing back. The Nasdaq doing nicely, up by 0.7. Under surveillance this morning, Japan betting big on the U.S.
They just signed the largest trade deal in history. I think maybe the largest deal in history with Japan. We worked on it long and hard, and it's a great deal for everybody. It's a great deal. A lot different from the deals in the past, I can tell you that. We're doing things that have never been done in this country before, and our country is becoming very rich again, and that's the way it should be.
So here's the latest this morning. The president praising Tokyo's plan to invest up to $36 billion in U.S. oil, gas and critical mineral projects. This is the first tranche of its massive investment pledge as part of the U.S. trade deal. With more, here's Bloomberg's Tyler Kendall. Hey, Tyler.
Hey, John, good morning. Well, this was a long-awaited announcement that officials say will spur a wave of Japanese investment here in the U.S. This round includes 3 projects, according to the U.S. Commerce Department. The first, and the one with the most money behind it, would be a natural gas facility in Ohio, which, if built, would be the largest in the United States. The second is a crude export facility off the coast of Texas. And the third is a synthetic industrial diamond manufacturing facility in Georgia. Now, Japan's trade minister was here in Washington just last week, where he said the country is not seeking high-risk, high-return investments. We know financing decisions remain at the discretion of the Japanese government, though at this point it is unclear how much of this will be direct investment compared to, say, loan guarantees, though it is our understanding that profits are set to be split 50-50 until Japan recoups its initial investment, and then that split is going to go to 90-10 in favor of the United States. One thing is clear, though, which is that once a project is announced, Japan has 45 days to fund it, or else they could face higher tariffs, according to the trade agreement reached between the two countries. And as Japanese companies try to navigate the current tariff regime, which includes that more preferential 15% rate, data released yesterday shows that Japanese exports are increasing at their fastest clip in more than 3 years. Though when you look at exports to the U.S. in January, they fell 5% from a year prior. John, prioritizing getting this agreement into place will be top of the agenda when Japan's Prime Minister Takaichi visits here in Washington next month, though we have to keep our eye on this Friday when the Supreme Court could rule on President Trump's broad-based IEEPA tariffs, and that could complicate matters, including this trade agreement.
The big thing to watch going into the weekend. Tyler, thank you. Tyler Kendall with the latest in Washington. Jim Zelter, the president of Apollo Global Management, still with us around the table. Jim, just back from Tokyo, of course. These numbers are big. Do you still think we sit here and we underestimate the amount of capital investment that will be deployed into this country over the next year?
I do. I think the administration went out and they structured, from our understanding, 6 of these agreements, 3 in Asia-Pac, 3 in the Middle East. This is the first to actually get announced. And when I've been here before and we've talked, you know, the center of the fairway in the U.S. economy and the global economy is quite strong right now. You have an administration that is very pro-business and very much into trade agreements and bringing FDI into the U.S. You got a major M&A boom. You got a major CapEx boom. You know, certainly the center of the fairway is pretty strong. So I do think you're going to see more of these. I do think the worry is on in the rough, if you would, so as I've spoken about, in terms of not only the concerns. Inflation feels like it's a bit matted down. Geopolitics is a bit matted down right now. I think the worry that we see is a bit of consumer sentiment. Some of the consumer sentiment numbers are very, very challenging. They're not in the data yet. We'll keep an eye on how those progress, but certainly this administration is doing a strong job by this agreement plus the 4 or 5 that are behind it.
The investments helping GDP. Is it helping jobs growth?
I think that's a big open question right now, and I think that when we have these conversations about the impact of AI in terms of chips and CapEx and energy and power, I think Torsten's talked a lot about this concept of a K economy. And I think you're going to have more and more companies fit into that. The top of the K is companies that are winners, that are having access to capital, that are getting data, that are getting energy and power to be able to really benefit. And the bottom of the K is companies that are really under a tremendous amount of margin pressure. And I don't think, if you ask me, well, like, what's not in the marketplace long term, I don't think the second and third derivative of the long-term impact of productivity and actual employment and then consumer spending, I don't think that's really in the marketplace. And I suspect if I was to get invited back later this year to have that conversation about the emergence of the K economy, K companies, and what's the second and third derivative to consumer confidence, consumer spending, and the overall economic growth.
Jim, you know you have an open invitation. Anytime you want to come, you can be here, and you will be here. I just want to build on this idea, because there's a fierce debate right now about whether AI really will disrupt corporate America, whether it really will eradicate the need for a lot of white-collar workers. What are you seeing in portfolio companies? What are you hearing from some of your colleagues in the industry about how much people are restraining from hiring people or potentially ratcheting back their hiring plans going forward as a result of some of these technological shifts?
I think there's the immediate euphoria when one goes home and tries out these applications and figures out what it can do. They come in and say, you know, why are we doing X? Why are we doing Y? But I don't think you've seen broad-based evolutionary strategy in hiring across our portfolio companies. There's certainly a degree of discipline that's being brought to the forefront, but I don't think there's a massive strategic change at this point that I've seen. I still think it's quite a bit early. I think people are trying to anticipate productivity gains and what makes sense in terms of their business model, but I've not seen wholesale approach changes of hiring in the companies that we've overseen today. Now, there's obviously exceptions to that. There's some on areas that are much more impacted that will take a greater degree of change. But I think that's a story that will continue to evolve.
The hiring issue is a massive problem, potentially, for the politicians. How they respond to that, I think, is really difficult to price. It's so far out there. It's just not on the market's radar right now. We're asking the question, but I don't know if the president can get through the idea of saying capping interest rates on credit cards is a risk. Can he get it through Congress? Got no idea. Who's going to be in the White House 2 years from now? What kind of policies are they being elected on? I don't know. But that's a risk, and it's something we're going to have to confront in the years to come.
And right now, it seems like there's a constraint where Washington doesn't want to fall behind China, so they don't want to regulate a lot of the technology. And when you get a response, it's going to be when there are people angry, not necessarily trying to be proactive and try to do training programs and incentivize companies to hire people to potentially train in positions that will be relevant.
Jim, 30 seconds. Got enough time for a final word, please?
Pardon?
Got enough time for a final word. 30 seconds if you can.
You know, listen, I think this last conversation is one we're going to be continuing to have. I think the market the last 10, 15 years, monetary, liquidity driven, and this is a much broader evolution of a capital allocation, long-term retirement and fiscal challenges. And I think that's the conversation that I suspect it may not be day-to-day what's driving individual stock performance, but I think it will drive economic performance over a cycle. And I know that's where we have positioned. I talk about the boulders. The boulders are still big retirement problems around the globe.
Jim Zelter of Apollo. It's good to see you. Thank you, sir.
Thank you.
The president of Apollo Global Management. Coming up next, we'll catch up with Mitchell Green of Lead Edge Capital, challenging the narrative that enterprise software is obsolete. Plus, Yahira has your morning movers. Palantir rising on a fresh upgrade. That stock is up by 3% in the pre-market. The opening about 2 hours away. Equity futures on the S&P positive by 0.4. On the Nasdaq, we're higher by 0.6. If you switch on the board and get to the bond market, yields off the lows of the year. A bounce yesterday, encouraged by some hawkish Fed speak. Yields up by 2 basis points this morning. At the front end of the curve, 344.91 on twos. As we count you down, let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We start with Palantir. Shares are rising 3%. And no, it's not about its move to Miami. It's on some sell-side action. Mizuho upgrading the stock to outperform, the analysts calling the company in the category of one for its combination of revenue acceleration and margin expansion. The analyst also says that the recent pullback in the stock is resetting the valuation, and they see more than 40% upside from these current levels. Moving on to cybersecurity firm Palo Alto Networks. Shares are falling more than 6% in the pre-market after it cut its profit outlook. Palo Alto has been spending aggressively on acquisitions. It even announced one yesterday. So that push is weighing on profits, and that is doing little to ease investor concerns around the name, which was down nearly 9% heading into the earnings after the software pullback that we've seen over the last few weeks. And we typically think of hedge funds when we're tracking these 13F filings, but today it's all about NVIDIA. It's creating some winners and losers this morning. Take a look at Applied Digital shares down 7.5%. Recursion Pharmaceuticals also down after it announced that it exited its stakes in those companies, but it's also creating some winners with Synopsys, the chip design software firm, up 3.5% after it disclosed a stake in that company. John?
Yeah, thank you. 13 Fs out of NVIDIA. That's the world we're in.
I mean, right now, NVIDIA is the biggest asset manager out there and can pick winners and losers in the tech sector, and who they bless gets blessed by the market.
True. Big halo effect. Big halo effect. Stocks are positive by about 1/3% on the S&P this morning. On our radar, the New York City Mayor, Zohran Mamdani, floating a last resort property tax hike if Governor Kathy Hochul won't raise taxes on corporations and the wealthy. The mayor looking to help fill a $5 billion budget gap. Elsewhere, Meta agreeing to deploy millions of NVIDIA processors over the next few years, tightening its relationship with the AI chip maker. The rollout will include products based on NVIDIA's current Blackwell chips and the upcoming Vera Rubin design. And finally, the San Francisco Fed President Mary Daly urging policymakers to recognize signs that AI will impact the U.S. economy.
Right now, while we can't find it in the macro studies that would do very sophisticated empirical econometrics and ask the questions, how much of this is AI, we still can see that there's something going on there. The question isn't, is it happening? The question is, how long will it persist?
Kevin Walsh, the president's Fed chair pick, argues an AI-fueled productivity boom should lead policymakers to lower interest rates, and pushback to those comments just yesterday.
Honestly, this is anybody's guess because you're not seeing the actual numbers. And you can look at Claude or you could look at ChatGPT and say, wow, they're smarter than I am. And frankly, they should probably be doing my job. At the same time, the frictions to get there are questionable, and how quickly that will really lead to a mass sort of reluctance to hire. Very unclear. What we're seeing right now with the productivity increases, a lot of people attribute to changes that happened after the pandemic more than AI adoption yet. What this does, though, clearly it's going to be transformative. Again, how many times can policymakers say, I don't know? If they say anything else, well, they'd be lying because we don't have a sense of exactly how this is going to
Some people aren't burying their heads in the sand, though. I thought you did a great job of this yesterday, just really outlining the difference between what you're hearing from industry leaders, the damage this could do to white-collar jobs, and what you're seeing from Wall Street economists who are forecasting decent GDP growth and a recoupling with payrolls growth over the next 12 months.
This is the dilemma right now. How do you get a situation where you have a boom without jobs? Is that feasible? Or are you still seeing people hiring because, frankly, they didn't hire for so many years after the pandemic? Is this just essentially a response to quiet quitting? If you're going to come to work, you better do something. Otherwise, I'm going to have Claude come get you. I mean, how much is this going to be to create some leverage?
What's the difference?
I mean, ultimately, we don't know, and there clearly is something significant going on. Whether this results in unemployment rates shooting higher, I mean, this is the real question right now.
Let's keep it on technology. Anthropic launching its second major AI model in just under 2 weeks, further intensifying pressure on the software industry. The team at Lead Edge Capital, a growth equity firm, writing the complete obsolescence of enterprise software is overblown. There will be winners and losers, but the best companies have an ability to adapt and still have strong terminal value. Mitchell Green, the founder of Lead Edge Capital, joins us now for more. Mitchell, good morning. Good to see you.
I just smile as you guys say these things.
Well, what, do you think I'm wrong?
I think if you are a company that has to, if you're these AI companies justifying hundreds of billions of dollars of AI spend, you sure better convince the world that every white-collar job is going to disappear.
So is this the IPO roadshow that we've been talking about? Because that is something we've suggested.
I think I think we're in a giant AI capex bubble right now, and I think it's going to end very bad. I do think AI is going to revolutionize the world. I don't think in the next 2 years that AI is going to be doing the two of our, taxes, and your agent's going to be talking to my agent, and then they can negotiate our salaries together. I do believe that people underestimate the long-term aspects of it, but they sure overestimate the near-term aspects. Remember in 2015, everybody was talking about self-driving cars? 2000, we could have sat here in the show, talked about the internet. You know who typically won the e-commerce game? Traditional retailers. Walmart, Macy's, Home Depot. By the way, in 2000, we could have sat here. Social media, now a $3 trillion market, didn't exist. And so we're in the very early innings of it. But the whole idea that software is overblown is totally insane. I was with somebody that runs a big hospital system yesterday, and they were like, well, I sure hope my IT department doesn't start building HR software. And for my patients, I really hope our IT department doesn't start, building all the, ripping out Epic systems and doing all this stuff. It's like a bunch of nonsense.
So near term, long term. Let's start with near term.
Yeah.
Called a CapEx bubble. What makes it a CapEx bubble? Let's just get into that first, and then we can talk about the long term opportunity.
The amount of money being spent in terms of how many dollars are going into these things. I think they want to build something like 300 gigawatts, whatever, of capacity. If you start to then actually analyze how much power you actually need to do that, how much power you need for nuclear power plants and all these things. We just don't have the power in the United States to do this. Where I actually think a country like China could potentially leapfrog us in a lot of ways, is they can get a lot more capacity a lot easier than we do.
This is sort of a question around how much ex-US is really highlighting the AI CapEx bubble in the United States and saying, well, China is doing it better. Is that kind of how you see it right now?
I think that's the part way we see it. I also believe, just look at the models coming out of China, a lot of these open source models, which you can run locally, by the way, are much more efficient. They were developed at a fraction of the cost. They require end customers to spend a fraction of the money. You're running a DeepSeek model versus running an Anthropic model. Again, I'm not saying that Goldman Sachs or Morgan Stanley or, United Healthcare are going to go run a bunch of Chinese models, but you can run them locally. I do think globally, you're going to have a lot of other companies that can say, look, I can get 1/20th the cost and run a model at, in terms of, I'll run a Chinese model, it'll be much cheaper. But the idea that software is dead is absurd. Toast grew 26% last quarter year over year. Datadog grew 29%. ServiceNow grew 20%. Microsoft grew 15%. HubSpot grew 18%. These companies are not disappearing.
But the argument isn't that they're going to die or that they disappear. It's just the margins are going to compress dramatically. That sort of the barriers to entry come down significantly, given the fact that Claude or ChatGPT can program a lot of this stuff and get in and do a lot of what they do pretty quickly. How would you push back against that when it's sort of a counterfactual? You can't sort of disprove what some of the technology could potentially evolve to.
Keep in mind that software companies' core competitive advantages have never been about R&D. We're not building semiconductor chips. These companies are not building semiconductor chips like NVIDIA or Intel or things like that. And so, yes, 3 guys in a shed can use AI software to try to start building software. But keep in mind, Salesforce probably has 10,000 software engineers. These people aren't just sitting around on their thumbs doing anything. They're also going to use the software. So our belief is if you're a software company and next year you thought you'd have 200 software engineers a couple of years ago, we think you still should have 200 software engineers. But guess what? You should be able to build more code and more products with the same amount of people. We do not think it is a good idea for a company to cut their engineering count in half just because you can use Claude and stuff. You should be using Claude as well to produce more products, and then you can use your sales and marketing team, which can be even more efficient than it was before and be more productive to even sell more. So we think you very well could see a bunch of. Now again, you will have companies that win and you will have companies that lose. In the internet e-commerce of 99 and 2000, Target won, Home Depot won, Walmart won. Amazon was created new. Guess what? Sears, Bed Bath & Beyond, Kmart, and a bunch of other retailers, Montgomery Ward and long list, went out of business. It's because those companies either were levered with debt and didn't innovate. The same thing will happen here.
Mitchell, what do you think the bust is going to look like? You've called this a CapEx bubble. What do you think the bust will look like?
If I could figure that out, I wouldn't be on TV talking about it.
Well, I think that's what a lot of people are asking, watching as you describe it.
What do I think is going to... we worry about some of the stuff in the private credit markets. We just worry about some of the circularity things. But Palantir was upgraded today. It's an amazing company. We could argue if it's the right valuation or not, or any of these companies. But Alex and the team have built and we don't own the stock, have built an incredible business. And, you are going to see a huge amount of companies. There will be winners and losers like there are, but the whole idea of a whole industry going away is crazy. Like, think about the number of people in Bloomberg. You could argue, people aren't, this week people aren't like, all the media companies are going to go out of business. It's just not going to happen. Like, you're going to be able to do more. You're going to be able to be more informed when you're on the air, things like that.
You said something earlier that got my attention, new business models and things we haven't even begun to think about.
Yes.
Can you describe the kind of opportunities that are opening up already that you and the team have identified?
Well, we think you're going to see a lot of things around like healthcare. So we're an investor in a company called Pacemate. It makes like cardiac monitoring software. If you put a pacemaker in your body, that device has to send data to the end, to like your doctor. Now, what the company has right now is a bunch of people in the service center that they can only, each person can monitor so many devices. Now, can you use they're using AI to be able to make it more efficient, so they can onboard more and more cardiac clinics and not add as many people to do it.
Which companies are most susceptible to a AI capex cycle bubble bursting?
The data center companies, for sure. I think people are going to overbuild data centers or not be able to get power to data centers. Just go look what happened in the telecom bubble when they overbuilt capacity. The issue here is, that's a little bit different about it, is in the fiber bubble, the overbuilding of fiber, they just capped the lines and came back 10 years later. The problem today is you put chips in these data centers. Like, the question is how long is like the depreciation curves.
How big is the moat that insulates a lot of U.S. assets from a capex bubble deflating, given that has really led indexes higher? I mean, how much is that part of what we're seeing with people looking outside of the United States?
I think people are worried about it, but bubbles can go on. Like, Howard Marks has written amazing things about, when it looks like a bubble, smells like a bubble, it probably is a bubble. Trying to predict when these things are going to pop is a fool's game. And by the way, being early to call the bubble and getting out is this equivalent of being wrong as well. We struggle a lot with just the absolute dollars that are being thrown into this. We think it's very real, though, and there will be giant businesses created. But the amount of capital being thrown at it and the losses that some of these companies are generating is absolutely, mind-boggling.
Can we finish on the politics? We've talked in the past about ByteDance, which has been caught up with national security concerns. Alibaba, again, more recently, tied up with allegations coming from the US government and its ability to maybe operate independently away from the military in China, or lack thereof. I wonder what that opportunity is going to look like in the years to come for you, and the kind of risk you'd be willing to take in China with the opportunity around the AI story, if it is of the utmost importance to national security to beat China here in the US.
I think it's going to continue to be an issue. Both countries need to learn to work together, though. We're both too, and I think you're starting to see it. Like 2 years ago, 18 months ago, it was like, if you look at stocks like Alibaba or Tencent, they've doubled off the lows. I think the market understands that both countries need to figure out how to work together. Otherwise, 1 + 1 = 4, it's not the reverse. And so, but I do believe that both countries you're going to see tons of this stuff. Like, oh, you can use this NVIDIA chip, you can't use this chip, restrictions on these things.
It's not holding you back from investing in Chinese tech, though.
We historically have, the stuff we've done in China has historically been giant businesses that generate giant amount of profit along the way. We were investors in Alibaba, but when we invested in Alibaba, it had billions of profits. Tencent Music was a huge business. Ant Financial is a huge business. ByteDance is a gigantic business. And so we like to joke that if a Chinese company gets to us in New York, they sure flew over a lot of people to get to us. And so we're not investing in the early stage. You can go talk to Neil Chen and guys like that are incredible early stage investors.
Mitchell, it's good to see you.
Yeah, thanks for having me on.
Giving us tons to think about. Thank you, sir.
Absolutely.
Thank you very much. Mitchell Green there of Lead Edge Capital with his view on a capex bubble. Already getting a lot of feedback from Bloomberg subscribers off the back of that this morning.
I mean, this is a $650 billion question, at least for 4 companies. Is it going to be worth it? His attitude? Not so much.
Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. European Central Bank President Christine Lagarde is expected to step down from her role before her term ends October 2027. The Financial Times is reporting Lagarde wants to leave before the French presidential election in April of next year. That move would allow French President Emmanuel Macron and German Chancellor Friedrich Merz to find her replacement together. Shares of Bayer falling in European trading. The German conglomerate is agreeing to pay more than $7 billion in a bid to settle current and future cancer lawsuits tied to its Roundup weed killer. The proposed class action settlement would resolve previous cases and potential claims to be filed over a 21-year period. Bayer has reached a separate settlement with Roundup users claiming the herbicide caused their non-Hodgkin's lymphoma. Jeff Bezos' space company Blue Origin is vowing to beat SpaceX in the moon race. The company's CEO spoke to Annmarie Hordern at the Defense Tech Summit.
SpaceX doesn't have to lose for Blue to succeed. What the U.S. needs is it needs two SpaceXs. It needs two launch companies that are competing vigorously against each other to try to give us the most capabilities as a country, commercially, civilly, from a defense perspective, because our adversaries aren't standing still. And so we need to be moving very quickly.
Blue Origin's Limp also telling Annmarie that the company is shifting employees from its space tourism program to focus on lunar projects. And that's your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in the next hour. Up next on the programme, hiding from AI disruption.
There will be more of an emphasis on people leaning into companies that seem less disruptible, where people are like, no matter what happens, they're going to go there. People are looking for the places that are least vulnerable.
Up next, we'll catch up with Oliver Chen of TD Cowen from New York City. You're watching Bloomberg TV. Equity futures softer here, or firmer rather, by a third of 1%. Used to saying softer, but over the previous 2 days, we've actually put out some marginal gains, particularly yesterday. On the S&P 500 this morning, up by a third. On the Nasdaq, up by 0.4. In the bond market, yields continue to move off the lows of the year, up by a single basis point at the front end of the curve. Twos at 344. Under surveillance this morning, hiding from AI disruption.
There will be more of an emphasis on people leaning into companies that seem less disruptible. You look at those giant moats where people are like, no matter what happens, they're going to go there. There's a reason that people feel more comfortable in that space right now, even if it is a high valuation space, because it seems a little bit harder to disintermediate buying stuff with AI. And it also seems like people are looking for the places that are least vulnerable.
So here's the latest this morning. AI disruption fears driving a rally in consumer staples. A test for the sector on deck with Walmart earnings due out tomorrow morning. Oliver Chen of TD Cowen has a buy rating on the stock, writing the following: we continue to be bullish on Walmart's ability to gain share across income cohorts. Oliver joins us now for more. Oliver, good to see you.
Pleasure being here.
Why is Walmart winning, and winning in quite a major way?
Walmart's doing a lot of things right. Value and convenience is really key for the customer, but you layer on a whole retail ecosystem, which involves technology and monetization of advertising as well as a marketplace model. So you're getting that AI component, but you're also getting value and convenience. That being said, some risk factors into tomorrow. Estimates are fairly high for next year, looking at double-digit growth, and this company is a very conservative guider. So near term could be somewhat cautious on a high PE, but long term, it's our best idea, and we've been recommending this for many years. They've done a great job pioneering the integration of AI into retail. And as we look at structural changes, retail is much like an ecosystem, and rethinking how to monetize traffic in different ways is what Walmart is doing well, in addition to having a bottom line, excellent grocery business, which is really the basics of retail.
Well, let's stay on the technological aspect of all of this. So Mitchell Green of Lead Edge Capital was just on with us, and he really highlighted the fact that the incumbent ended up winning the internet race, that Walmart ended up doing really well. What's special about the management teams within that company that are able to develop alongside these technological innovations?
What's been really exciting is proximity really matters. So 90% of America within 10 miles of Walmart. And we've been talking about phygital for many years, which basically means physical meets digital. Walmart, a decade ago, has really been focused on robotics and inventory management. And now you have value and convenience plus a data flywheel. For AI to work, it needs velocity, veracity, frequency of purchase, context, personalization. In grocery, it's actually a very low margin business. It's very hard, but you have that frequency of the data, which really works in its favor. Overall, what we're seeing is the importance of blending physical and digital, and you mix in AI, lots of personalization. The bottom line, more convenient for the customer, and you get inventory management as well as personalization. So a lot's working, and scale really does matter. So the future of AI will partly depend on scale, and thinking about these companies as data platforms is what's happening as well.
Is Walmart winning at the expense of everybody else? I mean, who else has the phygital footprint? I just wanted to say phygital. The phygital footprint that Walmart does and can really monetize it the same kind of way.
We're also excited about names like Costco, but this theme is very true, the big getting bigger. And that's true because keep in mind, Walmart's e-commerce is just turning profitable. So running these businesses is extremely difficult in terms of profitability because you do need this scale of many, many deliveries. So that's something to be seen. But the bottom line is they've been taking share from other players, and grocery is somewhat fragmented. And having a leading loyalty program is difficult.
So it just raises a question of how much bankruptcy and how much we're going to see just complete insolvency littered in the wake of the phygital dominant player here of Walmart. I mean, how quickly do you see this transition really transpiring?
It's another great theme in terms of bifurcation, where we see the high end really working and middle and lower a lot more pressured. So retail's been on this journey, and what's been tough is if you're stuck in the middle. The regional grocers, as well as the shopping mall, as well as department stores, it's been very difficult for them to comp positively. Also, Target is a name we're watching too, where consumer discretionary and negative trends there have really contrasted with the positive 4+ at Walmart. So the battle is yet to be evolved, but on the future is really this agentic revolution in retail and what will need to happen next in terms of customers expecting even faster and faster deliveries. So lots of drama ahead, and it's been unfortunate with Saks Global.
Target up 19% year to date, by the way. Some people are starting to buy into the turnaround.
Yeah, turnaround is the key question, and how much.
It's been troublesome.
Yeah, and how much those shares have been down over the past few years. I just wonder who can compete, given the footprint, given the scale of data, and how they can really monetize data in a new way, as well as some of the big management teams. I mean, that's how do you compete against Walmart?
You see that blink, and we're talking about Walmart.
I know. But that is sold on Walmart. That's the thing, is that they're catering to that Oliver Chen consumer.
Some of that is not available on Walmart.
Well, there is great stuff on Walmart, from vintage Hermes to even their private label brands. And Walmart's also getting a higher income customer. So it's really benefiting from these different forces. At Target and Target, a lot of new management there. They have a very joyous, loyal customer.
Yep.
However, it's been very inconsistent, and back to the basics of retail, they need a faster supply chain.
I've got to go, but that was a good save. It's good to see you. Oliver Chen of TD Cowen, thank you, sir.
What we're seeing is a change in sentiment around the tech and the AI trade.
AI has been sort of like a heat-seeking missile looking at different sectors.
There's definitely a lot of fears in the market right now, and not everything's really rational.
The uncertainty in AI suggests that that entire trade is going to remain challenging.
It feels like the bull market in AI disruption and hysteria has really taken off.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your scores look like this. The bounce continues. Equities up on the S&P by 0.4%. It fades a little on the Nasdaq. The Nasdaq 100 still higher by 0.5%. In the bond market, a bounce off year-to-date lows on 2s and 10s. The 10-year yield just about unchanged on the session. The 2-year at 3.45.
Yeah, and how much has this come because of some Fed speak that was a bit more hawkish? We did hear, of course, from Goolsbee and from Barr talking about the need to see more progress on inflation. How much is this just the shifting sands that we see in markets right now, where people sort of exhaust themselves on a trade and then shift to another one? I mean, it feels like an incredibly technical market that we're trying to give narratives to, but ultimately, good luck, because this feels like whack-a-mole. And so we're going to try to talk about whack-a-mole this hour.
When it comes to the Fed speak, 2 p.m. Eastern time, for the Fed meeting minutes. Look out for that. We'll go through all the details for you right here on Bloomberg TV. The takeaway from the last hour, Mitchell Green of Lead Edge Capital coming out swinging, calling this a major capex tech bubble.
Yeah, I wonder how much that's underpinning a lot of the ex-U.S. trade. This fear that the United States and some of the biggest firms are spending too much money on the build-out. It speaks to what we were speaking about with Elyas Galou of Bank of America, talking about how a huge number of investors think that a lot of these companies are spending way too much and would like to see it ratcheted back. Question is, what are they spending it on? You know, where are the misinvestments going to be, and how does the market calibrate that at a time of dramatic change? This ultimately will be the question.
Ben Affleck should start his own Wall Street research firm by the sounds of it.
He probably has.
Those quotes, that statement to Joe Rogan, a lot of people agree with it. There's some big companies doing a lot of spending that needs to justify some rather large valuations. And as some IPOs come into market later this year, that needs to justify some very large valuations. And to do that, you need to come out with some very big headlines, and we've seen plenty of them over the past few weeks.
All white-collar jobs done in the next 12 to 18 months. Buy our stock. And so this is a reason why you're seeing some skepticism cast on that, which goes to the whack-a-mole. People freak out. Then all of a sudden, things feel oversold. People go back into that. This is sort of a trading market without a real cohesive narrative, because there's a lot that still is unknown about what this technology will do and what the ramifications will be on the labor market.
Unfortunately, if you're exhausted by all of this feels like the start of a phase and not the end of one.
Thanks.
And this might be the next year.
Are you just sick of this kind of attitude?
Just saying.
Please get it together. This is going to be great.
Might define the year ahead.
It will, and it's actually exciting. Don't get me wrong. Love it. It just is a question of what is true and what is actually just fiction.
Love it so much you're sick of it by February 18th.
Whatever.
It's going to be quite a year. Futures positive by a third of 1% on the S&P. Coming up this hour, Alicia Levine of BNY Wealth with stocks edging higher. Gil Luria of DA Davidson on why it's time to buy software. And Nouriel Roubini of Roubini Macro Associates with Fed officials warning about the impact of AI on interest rates. We begin this hour with stocks rebounding. Alicia Levine of BNY Wealth writing the rotation is painful in AI-disrupted sectors and likely due to revert later in the year. We think there is room to run for tech to regain leadership. Alicia joins us now for more. Alicia, good morning.
Good morning.
Let's get into it then. OK, is this a rotation or should we be preparing for a much bigger index level correction?
So there's a clear rotation, and the rotation started November 1st of last year, very clear. And that is because of two things. One, the spending in the AI-related names is now eating up a lot of the free cash flow, which was the story of why you wanted to own these names. They were seen as bonds, throwing off cash, and so you could get the higher multiple, you drive the margin of the entire S&P through these names. When that story changes, if 92% of the free cash flow is going towards CapEx, that's a different story. So then you have questioning of the narrative, and this started back in November of last year, because that's when we had earnings season. We saw the ratcheting up in some of these names, where all of a sudden, maybe it's not helping the business model, maybe they're not driving revenue from it, and so there's the questions. That's what we're seeing. And the other thing that's happening is we have a great macro backdrop globally, U.S. and globally, and so you have the cyclical rotation. Get out of the names where you're not quite sure the CapEx is going to get you anywhere, and go to where you have growth and lower valuations, and everybody's ignored. And that's the story. So I think there's pain on the index to remain, but 70% of the S&P is above the 200-day moving average. You would not know that actually it's quite a strong market underneath the index level. And I think this is going to remain for a while. Having said that, there's clear, you can get reversion to the mean all throughout the year. And I'd say the issue now, of course, is the consensus trade is get out of tech and go into cyclicals. That is the consensus trade. Go rest of world, go emerging markets, go Europe. So now everybody's talking about that. And in the meantime, the dollar has not weakened any further since the Kevin Warsh announcement.
Well, let's get to the consensus trade. What is the recent performance, and I stress recent performance, of banks and discretionary tell you about that trade?
It's telling you that maybe the cyclical recovery is not quite there. I mean, we saw that actually with the housing data so weak last year. You saw all of a sudden yields drop and the banks starting to sell off. The other consensus trade coming to the year, we've been talking about this at BNY, which is, the steepening of the yield curve is really underpinning a lot of asset allocation and a lot of trades. And what we've seen as yields have come down, you've had a flattening, and all those favored trades have sold off a little bit to the real world, right? So I call it the dirty businesses, the materials, the industrials, transports, all the stuff. physical world making things, and that's where you're seeing the capital going. I think ultimately, though, if you're not going to have that kind of growth and you still have the best growth in the market coming from tech, eventually investors will go back to tech.
So is that what you're doing right now? Do you see this as an opportunity?
So we've already reallocated into the end of the year. We had that massive outperformance of rest of world in the first quarter of last year. And we said for the rest of the year, we just think that the U.S. is going to catch up on this. So we sat still. We sat still because we were very convinced that the U.S. was going to outperform the rest of the year. And in fact, that's what happened. But in the last year, we did move allocation into the rest of world emerging markets. We're very bullish on emerging markets because of the global growth, because there's been a global central bank cutting of rates. So you're getting the growth coming in now, and the dollar is weaker. We don't think the dollar weakens much further, but we don't see a massive reversion to dollar strength here. That's good for emerging markets. So we like it on the debt side as well as the equity side.
Is the money coming out of the United States because it's being pulled for the opportunities or pushed because people are worried about what Mitchell Green was talking about with some sort of CapEx bubble that seems like it's just destined for losses and potential contagion?
Look, I think the market's done a good job in re-rating that risk, right? So if you think about what's happened just on the Mag 7, those names have been re-rated, and the disrupted sectors have been re-rated as well. But I just want to make one point about money coming out of the U.S. Money's coming into the U.S. for the U.S. equity market. It is the allocations that are also moving around a little bit. I think that it's not just the fear of AI, but the sense that there's opportunity. So it's not a running away, it's a running towards. If you think about the underperformance of rest of world since 2010, there's a lot of catch up to do. And so there's excitement about the opportunities, not necessarily the CapEx is going to kill the U.S. market. We don't see that. We think that the re-rating has done a good job of preventing actually the bubble from happening.
You've seen the Eurozone bank run over the past 3 years. I was going through the numbers. 2023 up 23%, 24 up 23%, 2025 up 80%. If you're thinking about that trade now, so much of that trade has already happened in Europe in the financials. They've had a massive run over the previous 3 years.
Yeah, but now they've got materials companies, and suddenly the ball has shifted in terms of what the story is. And this is a reason why it feels a little bit like whack-a-mole and follow the crowd, because right now the tide is shifting and it really benefits the FTSE. You've pointed this out, the idea that that's really the mining and metals companies that are based there. And how much does that, catch up come from other places
and
now?
2 names in South Korea.
Yeah.
I mean, talk about concentration in the US. How much concentration risk am I taking abroad at the moment?
Well, we've talked about this all the time last year when everybody was talking about concentration risk in the U.S. market. Actually, compared to global markets, the U.S. market was not as concentrated as Japan, as Korea, as Germany, as France, much less concentrated in the U.S., at the top 10 being about 38 to 40%. Germany, you've got 50%. Korea, you've got something like 50 to 60%. Japan as well. So there's concentrated risk in every global market. It's not that it's not a risk. It's that it's not unique to here. And so what's here is that you've got to keep corporate margins high. Now, the most recent quarter that's reported, the fourth quarter, highest operating margins ever. Okay, so we keep on ticking higher. That keeps the multiple in that 20 to 21 times range. We don't think that's expensive. That we think that's reasonable. And earnings for the 5th quarter in a row are coming in at double digits, far outpacing estimates. This is the fundamental for the market. We see the S&P ending the year about 7,600. You have to put a price target on it, so we do. But that doesn't mean it's going to be an easy walk. We always thought this year was going to be a nonlinear year. And as I like to say to my field, nonlinear means up and down, right? Not a straight line. And we've had 3 years of a straight line because of the AI trade. We're moving around now.
Well, let's call it 10% upside is basically what you're looking for on a cap-weighted S&P 500. People have questions about that.
Right.
And this will be the number one, I think, is that can you have a prolonged rotation without the index level being dragged down?
So right now we have a technical issue in the market in the sense that the technicals are starting to deteriorate. You look at a chart of the S&P, it's gone nowhere for 3 months. It's sitting at the 200-day moving average. So that's the issue, right? Like you have technicals that can take over as well. What I like to look at is, okay, technicals are technicals. The fundamentals tell me where I'm going for the next 12 to 18 months. The capital we allocate is 12 to 18 months, and we do long-term portfolios over a cycle. So I'm allocating around that 12 to 18-month horizon, but I care most about the fundamentals. The technicals will take care of themselves. That can mean a bad day, a bad month, a bad quarter, but we sit through it because of the conviction of where it's going.
We've had a few bad days over the last week.
We have.
That's for sure. Alicia, it's good to see you. Thank you.
Good to see you guys.
Alicia Levine of BNY Wealth. A wild few weeks at some points.
You know what it feels like? It feels like having a toddler. And you take them to a store, and they want that little toy. And you take them out of the store, and they're still screaming about that toy for a little bit longer until they take a nap, and then they wake up, and they're fine. And then they go and they find another toy, and they're screaming, and you don't buy it for them, et cetera. That's kind of what this market feels like right now.
You think everyone needs a nap? Is that basically what you're saying?
Well,
and
it's
I'm
just
lost.
that,
You think everyone needs a nap?
People need to exhaust themselves. Technicals need to exhaust themselves before you shift to another narrative.
You're having quite a morning, you are. All right. Let's give you an update on stories elsewhere this morning. With your Bloomberg brief is Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. Japan plans to invest $36 billion in U.S. oil, gas and critical minerals projects. It's the first part of a $550 billion commitment under the trade agreement struck with President Donald Trump. The investments include a natural gas plant in Ohio that the U.S. says will generate more than 9 gigawatts of power. Also, a deep water oil export facility in the Gulf of Mexico. Anthropic releasing a new AI model that it says is better at using people's computers in increasingly complex ways. Claude Sonnet 4.6 can perform multi-step actions on a computer, such as filling out web forms and coordinating information across several browser tabs. Anthropic also says the model is more resilient against security threats. MSG Sports says its board of directors unanimously approved a plan to consider splitting its New York Knicks and New York Rangers businesses. According to Business Wire, the move would create 2 separate publicly traded companies. If the company follows through, the transaction will be structured as a tax-free spin-off to all shareholders. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Appreciate the update. More from Vonnie later this hour. Up next, the morning calls, plus Gil Luria of DA Davidson saying it's time to buy the software sale. That conversation up next, live from New York City this morning. Good morning.
On a short-term basis, the software sector has underperformed the overall market by the most since 2000. So I do think this sector is deeply oversold, ripe for a bounce, but I don't expect it to be new leadership because of that kind of inability to disprove the narrative longer term. But again, I think it is oversold here on a shorter term basis.
In other words, take a nap. That was Keith Lerner of Truist.
All right,
That's advice coming from Bramo this morning. But you all just need a little snooze.
Okay, that is not what I said.
Over the weekend.
I just said that it seems like having a toddler. That's
just
all.
Insulting our audience.
I'm not insulting them.
Behaving like toddlers that need, what, a sippy cup and...
Listen,
yeah?
I'm saying that we're really doing this. We have lots of things to talk about other than this. Let's move on.
Let's get to the price action. We're positive by 0.4% on the S&P, on the Nasdaq up by 0.5. Clearly, you all had a snooze last night. Let's get to your morning calls. First up, Morgan Stanley lowering its price target on Palo Alto, citing weakness in services revenue. Your second call from Citi, cutting its price target on Snowflake due to multiple compression in the software space. And finally, Mizuho upgrading Palantir to outperform, saying the company is, quote, delivering total revenue growth and margin expansion at scale, unlike anything else in software. That name is up by 3% this morning. Let's stick with software. Anthropic launching its second major AI model in under 2 weeks. The release adding pressure to the industry, already under siege over the past few weeks. Bloomberg's Anurag Rana joins us now for more. Anurag, let's talk about the product. What do we know about the latest release?
No, these are absolutely phenomenal models. They can help your productivity boost quite a bit, whether it's on the, your workflow point of view or controlling the computer. So I think the pace of innovation coming out from Anthropic has been so impressive in the last 12 months that it is, giving a pause to, let's say, the funding round of probably OpenAI at this time.
Where does it leave existing software players, Anurag, which have been under siege over the last 2 weeks or so? In fact, the whole sector's been trading soft since last year. What's behind that, and how are those companies attempting to counter it?
Yeah, I mean, this is an absolute, I would say genuine worry that a large model like Anthropic can come out and eat a lot of what they do. It's a very high margin business. So the worry is absolutely real. But our take is when you look at some of the larger vendors, the likes of, SAP, Workday, ServiceNow, I think these guys are embracing all these models at a very fast pace, and they will enhance their own products and ensure that they are continuously innovating and not be left behind, from a startup like Anthropic.
Anurag, to see Microsoft down to the extent it is, down by about 27% since the end of October. That's a name you cover. What's your reaction to a move like that?
I think a lot of it is tied to the OpenAI funding round and the trade because, we have seen them expanding their CapEx. The revenue has increased, and they talked about capacity constraints unless, otherwise Azure would have grown over 40%. So, we think over the long term, Microsoft is one of the AI winners. But right now, you are digesting a lot of investments that are going into their platform, and people are looking for the ROI or the improvement in sales growth rate, like what Google showed. But, both Amazon and Microsoft have not shown that.
Anurag, good to see you. Anurag Rana there of Bloomberg Intelligence. Gil Luria of D.A. Davidson weighing in on software, saying this: the software route appears overdone. We love the opportunity to buy software at these valuations. Gil joins us now for more. Gil, welcome to the show. Those stocks, many of those names in that sector have been absolutely hammered. Let's talk about why you believe this is the moment to step in. What gives you the conviction to make that call?
Because software stocks have never traded at these multiples, and yet their growth is very robust, especially the ones in the categories that aren't really even in a position to be disrupted. So if you're providing the infrastructure for AI, which is Microsoft, ServiceNow, Snowflake, Datadog, Dynatrace, JFrog, there's a whole list of companies that are not only providing the infrastructure for AI, already seeing revenue acceleration, but also providing these services to those AI native companies, to OpenAI and Anthropic. They're doing phenomenally well, and they're trading at unprecedented multiples. These are all companies that 3 years ago we were talking about them trading at 50 times revenue, 100 times revenue. Now we're talking about them trading at 20 times cash flow, 30 times cash flow. So it's an opportunity to buy them at a fantastic point in terms of their growth, at an unprecedented low valuation. It's an opportunity the market's given us as it's over-rotated, and we recommend that investors participate.
Microsoft is different than Snowflake in that not only is it a software provider, but it also is investing tens and hundreds of billions of dollars in the infrastructure that goes behind this. One of the big concerns is that they're over-investing and that they're going to suffer a lot of losses as a result. I mean, how do you sort of counter that narrative of the changed business model of a lot of these hyperscalers?
So first of all, Microsoft's growing faster than it has in a long time, revenue and earnings. So it's doing very well. And the CapEx investment is very substantial. To your point, they're using all their cash flow. They've already pre-sold all of that CapEx. They've pre-sold all these data centers in 3 to 5 year contracts at a markup, meaning that return is already built into these data centers they're building. Now, they're fully aware of the fact that because there's so much build out in the industry, there may end up being an overbuild at some point. They're fully aware of that, and there's two things they're doing about that. One is they're putting overflow capacity with other companies, Oracle, CoreWeave, and others, so they're not building to all of their demand. They're reselling other people's demand to make sure they're not overbuilding. And then they're also consciously building it in a fungible way. Meaning, if 3 years from now they realize the industry has built too many data centers, they can pause and digest that growth. They could use those data centers for the existing storage business, for AI compute, wherever it is, and then digest it, reduce the CapEx significantly at that point, while realizing those returns from the contracts they've already sold. This is a very deliberate, well thought out strategy that they're executing very well. They just won't get credit for it until those returns come in. But in the meantime, you can already see the revenue acceleration. To your point, they could have grown Azure more than 40%. That's a $120 billion business that they just grew 39%, and somehow investors were disappointed by that.
Gil, it's really interesting. So a lot of people come on the show and they talk about a contradiction, that investors both don't like the CapEx, but they also believe that there's going to be such massive disruption that a lot of software companies are going to go out of business. Pick one. You're picking both. You're saying that not only will there be significant advances from this CapEx and will it be justified, but these software companies will not be disrupted. They actually will be successful. Why do you think that it's okay to have both sides of the story, that you don't need to see that level of disruption and potentially white-collar jobs eradicated in order to justify some of these investment plans that some of the hyperscalers have?
because AI doesn't do what enterprise software companies do. AI is a cognitive task machine. It replaces labor. It enhances labor. It will make us better. It will make us more productive. It will help us use software better. For the foreseeable future, all these software packages are going to be used by humans and by AI. AI is going to be a labor enhancer. It's not addressing the enterprise software market. It's addressing the labor market. And that's the profound misunderstanding here. AI is a phenomenal technology. The capabilities are now growing exponentially and will grow even more exponentially once the models become recursive, but they'll make us more productive as employees, as consumers, which will make us use software even more effectively. Software companies understand AI better than anybody else. They're implementing, they're adapting to it. And frankly, for them, it's a cost that's now going down. Software companies don't sell software, they sell services. Software is a cost for them, and that cost is now going down very substantially because AI is the best at writing code. And so they actually have an opportunity to increase margins even further, which they are doing. It's just the market's ignoring that right now as it aggressively rotates into Walmart at 50 times.
Gil, thank you, sir. Lots to think about. Gil Luria there of D.A. Davidson. Big move into Walmart. 50 multiple. It's kind of wild going into earnings tomorrow. AI is a labour multiplier, is the takeaway from that conversation. Going into another conversation with an economist in just a moment who's got a similar way of looking at things.
Yeah, another way of putting that, long software, short humans, right? I mean, how much is this that the ultimate trade is that actually these apes are going to be just fine? The problem is that there'll be fewer people who will be needed for those jobs.
The issue I have, if you compare it to, say, the internet, lazy, imperfect example, but let's take the newspaper business. Didn't replace the writer, replaced the point of delivery. That you took it from a physical newspaper to a web page, but the writer still had a job. This, in many ways, is about replacing the writer in some cases. That is the stated aim, the stated goal.
And there were a lot of people who put the text on the page, all of those page placements that also lost their jobs. So there are job displacements in this process.
We'll talk more about this in just a moment. Nancy Lazar of Piper Sandler expecting CapEx to accelerate economic growth through the year ahead. Plus, Yahara has your morning movers looking at Madison Square Garden Sports. That stock is up by 9%. Couldn't we make it? A third day without losses. On the S&P right now, up by 0.4%. On the Nasdaq, up by 0.5%. And the Russell just about in positive territory. With your morning movers, let's cross over to Yahara for more. Hey, Yahara.
Hi, John. We are seeing Amazon shares up 1.4% in the pre-market, rebounding and building on yesterday's gains when it snapped a 9-day losing streak over its CapEx plans. And the rebound coming even with Berkshire Hathaway slashing its Amazon stake by more than 75% last quarter. That was according to its 13F filing, which was the last under CEO Warren Buffett. And speaking of those 13F filings, we usually think of Warren Buffett's Berkshire Hathaway, of course, and hedge funds, but it's NVIDIA stealing the spotlight. It's creating some winners and losers due to its 13F. It exited stakes in Applied Digital and Recursion Pharmaceuticals, so those shares are plunging, but also creating a winner in Synopsys. Those shares are up 3% after it disclosed a position in that company. And we end on Madison Square Garden Sports. Those shares up nearly 9% in the pre-market on breaking news moments ago that the board has unanimously approved exploring a spinoff of its two marquee franchises. The company is considering separating the New York Knicks and New York Rangers into two distinct publicly traded companies. No timetable yet and no guarantee it gets done, but investors clearly liking the idea of being able to invest in their sports teams. John?
Yahara, thank you. Appreciate the update. Yahara there with your morning movers going into the open in about 60 minutes from now. Got some breaking data just moments ago. Mike McKee has more. Morning, Mike.
Good morning, John. We're getting the last data that goes into the fourth quarter GDP figures, and so it does matter. Durable goods orders for December down 1.4% on a headline basis, but the number that will affect the GDP is capital goods orders, non-defense ex-air. That's up a healthy 0.6% after an 0.8 rise in November, a revised 0.8 rise. So some strength in durable goods orders going into the end of the fourth quarter, and that should provide a boost. Housing starts are out for December, 1,404,000. That is an increase from the October figure. We had a sort of November figure that didn't get published because of the government shutdown. But the number there you kind of want to look at is the number of housing completed, 2.3% above the November estimate, but down from December of 2024. Still shows there's a housing shortage out there. But those numbers will all feed into, as well as some inventory numbers, will feed into fourth quarter GDP. Look at the Atlanta Fed GDP Now figure that'll come out around 11 o'clock in the morning.
Mike McKee, looking at the data. Just to move on quickly, Mike, the Fed story of the last 24 hours. Big debate starting to emerge about what AI will do to productivity and ultimately what that should do to the neutral rate. What are people telling you, Mike?
Well, everybody is on hold right now, and what they're looking at are a number of different things. Of course, unemployment low but steady, inflation stable-ish but not falling, and you've got the Iran war threat pushing up oil prices, all things the Fed has to consider. But in the last couple of days, all we've heard about is AI from a lot of different members of the Fed. Philip Jefferson, the vice chair, Michael Barr, Mary Daly, all talking about the impact in the shorter run of AI. Long run, it could have productivity gains that would be helpful, but in the short run, it could push the neutral rate higher because there's competition for the available lending dollars, and that would mean that the Fed doesn't cut as much and has to worry about, with inflation, rising rates. Goolsbee does see cuts if inflation falls, but I think the if is doing a lot of work right there. And remember, the next meeting isn't until March 18th. There's one on April 29th as well. And the questions there is we're going to have a lot more data, including a new CPI, PPI, and jobs report, as well as a PCE, before even that March meeting. So we'll get some information today from the minutes, 3 weeks old. Not sure that or this data are going to really set us up to make any firm decisions on what the Fed's going to do.
Mike McKee, thank you, sir. Mike down in Washington, D.C. Let's keep it on tech and the U.S. economy. Nancy Lazar of Piper Sandler writes this. Between the AI arms race and the one big beautiful bill, our 8% total GDP capex estimate for 26 is too low, and something closer to 12% is more realistic. Nancy joins us now for more. Nancy, good morning. Good to see you.
Good morning.
These
nice
are some big numbers. Where does that leave total GDP for the next 12 months?
Well, overall, GDP is probably going to be about 3%. There will be some offsets. That is, you are likely to see deterioration in trade in 2026 as we increase imports after the tariff decline in trade in 2020, 2025. So net we're using 3, but I would say there certainly is upside to that number, something closer to 4, particularly for the first half of the year.
3 to 4, and a decent chunk is tech capex.
Yeah.
So how labor intensive is that growth?
Well, the key theme for 2026 is actually you're moving away from just tech, just S&P 500, just high-income consumers. To 2026, you're seeing a broadening out in the economy, not just tech. You're seeing heavy truck orders, for example, have increased dramatically. You're seeing non-tech related equipment. You're going to see more and more signs of factory construction. So the theme for 2026 is actually you're going to have a broadening out, a healthier economy. That middle to low-income consumer is going to benefit, along with more classic capex-related construction.
Why do you think that there will be this broadening out? If the sentiment surveys aren't keeping pace, if you're starting to see some of the retailers that cater to middle and lower income families talk about the struggle that's showing up in their numbers, what gives you confidence that that's going to change?
Well, you are seeing green shoots in goods-producing jobs. You saw it in the S&P manufacturing employment component, not the ISM, but the S&P. Their goods-producing employment component has clearly increased. We saw manufacturing jobs in January also increase. I've talked about this before. We have our own daily consumer confidence survey. It's been very robust as we start the new year. It's not just the high-end consumer. We are seeing non-investor consumer confidence also improve. So when we really look under the hood, we are seeing this broadening out. And don't forget, that was fourth quarter. The question is, where are we going to go here in the first part of 26? And I think it will be a healthier, more broad-based economy supported not just by the high end, but also the middle to low end.
People have been waiting for the strength that we saw in the services sector to shift over into manufacturing, and it does seem like that's starting to happen. At the same time, you are starting to see signs of weakness in the services services sector. We just got the New York Fed Services Index that came in at the lowest since 2021. So at what point do you start to see this and say, they're not going to necessarily just offset each other, that manufacturing really will carry the baton into strong growth?
So the higher end consumer certainly was a big support for the service sector, hotels, travel, et cetera, in 2025. That very well may moderate some in 2026. But again, it's more of a broad-based, healthier economic backdrop. Goods-producing jobs are magical in that they do create an economic multiplier. They do create a jobs multiplier, as we were just talking about. Growing up in Flint, Michigan, we clearly saw that for my father, not for me, with the construction of factories. You did see he wasn't in the factory business. He was a pharmacist. And so goods-producing jobs are really magical. And you see that unfolding right now, particularly down south in South Carolina, Georgia, Alabama, Mississippi, Texas, where you are getting these good-producing jobs. So it's a different economy as we shift into 2025, but I would argue a healthier, more broad-based economy.
Is the neutral rate moving up?
Pardon me?
Do you believe the neutral rate is moving up?
I'm not a believer in the neutral rate. I'm a believer in potential GDP growth. I'm a believer in nominal GDP growth. And those things do suggest, yes, the interest rate structure doesn't need to go back down towards zero, that the economy via productivity. I'm excited with the Fed talk about productivity. Powell actually started it back in December, continued it in his last presser, and now we're getting more Fed people talk about it. In a higher productivity environment, you have a stronger potential GDP environment. And in the 90s, when you had that backdrop, Greenspan lowered rates 75 basis points in 95. Then real rates actually rose as you went into 96. Inflation slowed, but real growth was actually higher. In a healthier productivity environment, stronger potential GDP, you have higher real incomes. You don't need lower rates. And if you get them, as Greenspan eventually did in 98, you end up with too big strong growth, and you end up with a boom and then a bust. So,
do you think that's a risk over the next 12 months?
I don't. I mean, I'm quite excited about the new Fed chair. He has a history of indeed being I would call it a more, I don't want to call him a hawk. I would call him a more responsible central.
What do you think his North Star will be?
Something aligned with potential GDP growth, real potential GDP growth, which again could be something close to 3%.
At this point going forward, I'm just curious about the frictions in adoption that are going to lead to that efficiency. And we keep talking about AI and what this could essentially do, but it's going to take some time. You hear from companies, they're not necessarily changing their hiring plans just yet because of artificial intelligence. They're not sure exactly how it's going to be deployed to a lot of different companies. What gives you confidence that increased productivity is a 2026 story in terms of its relationship to AI?
So first, I love your point that it takes time. I went back and looked at the 90s. Retail bookstores were going to be obviously a huge risk associated with the internet. And indeed, by 2000, 5 years after the internet boom really started, you then finally started to see retail book employment decline, bookstores starting to close. It takes time for this to impact. Second, on productivity in particular, it really started to improve last cycle. You saw it sort of inch higher, huge debate, 2016, 17, 18, and 19. So why did it start then? Because you had a capital spending cycle that actually started in 2010, 11, 12, 13. It was again led by tech, not AI, but tech. And so you did eventually start to see productivity improve in the back half of the last cycle, paused certainly by the COVID crisis, and now that's re-engineering. It's not as if, and now there's productivity. It's been in an improving trend.
So you could see Fed rate cuts even as we get all this CapEx spending because of disinflation, because we aren't seeing that boom yet from productivity tied to AI.
I'm not convinced you get Fed rate cuts. Again, I'm listening to what the current Fed people are talking about. They're focused on productivity is already improving. Powell said it at his December presser that productivity was in a rising trend for the past 5-6 years, not just related to AI, which I totally agree with. So again, it's not just inflation that drives the rate structure. As we saw in the back half of the 1990s, inflation slowed sharply, but real growth was 4%. And at the end of the day, the Fed cut rates in 95. Then they did it again in 98. But on balance, the rate structure stayed higher than I think people would have assumed because of that strong real growth, strong real income, not just real GDP, but also strong real income.
Nancy, it's good to see you. Some optimism
Thank you.
for the years ahead. Thank you. Nancy Lazar there of Piper Sandler. Stocks are positive by a few tenths of 1% on the S&P. With an update on stories worldwide with your Bloomberg brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. Meta agreeing to deploy millions of NVIDIA processors over the next few years. The rollout will include products based on NVIDIA's current Blackwell generation and the forthcoming Ferro Rubin AI accelerators. Meta also says it plans to rely on NVIDIA's Grace CPUs for the first time. Construction work on a $16 billion rail tunnel under the Hudson River will restart as soon as next week once the full $205 million of federal funding is received. The Gateway Development Commission has already received about half the frozen money and anticipates receiving the remaining $98 million to begin restarting the work. Stephen Colbert says he was blocked from airing an interview with a Democrat seeking a U.S. Senate seat in Texas. Colbert says CBS's lawyers were worried the interview would violate federal fairness rules. The interview with Representative James Tallarico was posted to the show's YouTube channel. And that is your Bloomberg Brief. John.
Some decent marketing, because I'm sure the hits on the YouTube video are great, and I'm sure that was the intention too.
Another roadshow.
You know, in the UK, this is pretty standard stuff, right? We used to have to manage this. In fact, the team in London manages this all the time. You have to make sure that if you give one person airtime, you give another person airtime. It's fairly down the middle. That's what you expect. They're the regulations.
I'm taking a page from this. Next time I'm outraged about my coffee. I plan to.
Bramo refused. She refused to let Roubini come on the programme live on TV, so I'm posting it to YouTube.
Yeah, that's a good idea.
Bramo refused.
Well.
And I've got the piece of paper here. Bramo said I'll get sued if I put Roubini up next. Is this how you're going to throw
me under the bus? I think you need a nap.
I'm going to break all the rules. Roubini's coming up next.
Trying to predict when these things are going to pop is a fool's game. Being early to call the bubble and getting out is this equivalent of being wrong as well. We struggle a lot with just the absolute dollars that are being thrown into this. We think it's very real, though, and there will be giant businesses created. But the amount of capital being thrown at it and the losses that some of these companies are generating is absolutely mind-boggling.
That was Mitchell Green of Lead Edge Capital. Absolutely fantastic, very opinionated earlier on this morning and pushing back against what he calls a major tech capex bubble.
Yeah, and he's got money behind it. I mean, he's been investing increasingly in Chinese technology and, frankly, in a lot of U.S. tech as well. But it's saying, look, a lot of this money is going to be throwing good money after bad, which really raises the question of how are we misvaluing some of the hyperscalers at a time where they're spending $650 billion for companies.
It's amazing.
It's just absolutely mind-boggling.
The numbers are absolutely humongous. Equity futures right now in the S&P positive by 1/3%. Your week and day ahead shaping up as follows. At 1 p.m. Eastern Time, a White House press briefing. 2 p.m. we get those Fed minutes. Tomorrow, Walmart earnings plus another round of jobless claims. On Friday, core PCE, UMich sentiment plus a possible, I stress possible, Supreme Court decision on President Trump's tariffs. Turning back to the Fed, officials suggesting productivity growth from AI could lead to higher interest rates. Nouriel Roubini of Roubini Macro Associates joins us now for more. Nouriel, good morning. Good to see you.
Great seeing you.
Walked into the studio and said no longer Dr. Gloom, Dr. Boom. Is that right? What's behind the new Dr. Boom?
Well, I've been arguing for over a year that there's a productivity growth acceleration because of technology of the future. Everybody's obsessed about Gen AI, but there's also semiconductors, robotic, automation, quantum, fusion, defense tech, fintech, new material science, space exploration, biomedical research, and so on and so on. They're all related to AI, but they're all separate, essentially, silos and verticals, and each one of them, thanks to AI, there's going to be a significant boom. U.S. is ahead in most of them, China is ahead in some of them. So it's a game between U.S. and China. That's why I've been saying that potential growth in the U.S. is already well above 2%, and by the end of the decade, it's going to be closer to 4%. I'm quite convinced of that. When I say to economists, they say you're crazy, 4% growth. But when I speak to technologists, they tell me you're still Dr. Doom because 4% is too low. It's going to be higher than that. But I think we'll be close to 4.
Let's say you're right. How does that change the outlook for interest rates, if at all?
Well, you know, Kevin Walsh argues, like some others, that that implies that because we're going to have lower inflation, that justifies lower Fed funds rate. I think is incorrect, because if potential growth is higher, the equilibrium real long rate and also the real short rate, Fed funds rate has to be higher, because there's a correlation between real growth potential and real interest rate. It's true that then inflation will be lower than 2%, maybe closer to 0. But today, say, you have a Fed funds rate where most of it is inflation and 1.5 of it is maybe the real rate. But once you have a growth of 3-4%, the equilibrium real rate has to be at least 3%. Maybe inflation is 1%, and then you get still at a 4% nominal. So having a lower inflation doesn't justify lower Fed funds rate if growth is higher, and growth is going to be higher. I think there's a fallacy in that argument.
Well, he might deliver it either way. And if that's the case, if there is a bias to cut at this FOMC in the face of what you're predicting, do we face a real risk of overheating?
Oh, yes, but I'm not sure he's going to be able to deliver it. You know, in the Fed system, the Fed chair is a primus inter partes, is a constitutional monarch, is not an absolute monarch. One vote, and he has to convince the rest of the FOMC to go along. And if the economy is strong as it is, and is accelerating, if inflation is still well above, target, and if it's not going to fall very much, it'll be hard even to justify one rate cut this year, let alone 2 of them. So he cannot really bully the committee. He could end up into a minority and be outvoted. So I'm not sure. And the data so far don't justify having lower Fed funds rates. Maybe one cut later this year in the second half if gradually inflation is going to be slightly lower. But growth is going to be very strong this year, much stronger than last year. I mean, Q3 growth was 4.3%. The last estimate of Q4 is 3.7%. So we don't even have that growth, recession that everybody was predicted. There's actually growth acceleration. And this year is going to be even stronger because you have the tailwinds from AI continuing. You have easy financial condition. Stock market and other indices are all-time high. You have the monetary easing in the pipeline, and you have fiscal stimulus because all the spending cuts were pushed until after the midterm election. So you have strong forces that will lead to an acceleration of the economy, not a slowdown of the economy.
I remember once upon a time, I knew someone whose name was Dr. Doom, and he talked about fiscal deficits.
Yeah.
He talked about the breakdown of world order.
Yeah.
He talked about inflation.
Yeah.
He talked about a shift away from the financialization of a world where suddenly you couldn't get these returns. What happened to him?
You know, I wrote this book, Mega Threats, in 2022, when I said that lots of trends are going to lead to lower growth and higher inflation. And that's exactly what happened. There were a whole bunch of factors, but there are also chapters on AI in which I said, if things that look like may happen, but it hadn't happened yet, because at that time in October 22, ChatGPT was not out yet. The proof that you could do fusion energy was not there. The improvements in quantum were not there. All those things happened. They were already in the book, and I said, if those things are going to happen, there'll be an acceleration of growth, reduction in inflation, and therefore we'll be in the utopian equilibrium as opposed to dystopian. And what was speculative at that time has materialized as being real since then. So since it happened, and I was writing about it, now I'm believing that actually tech optimism, that, as I said, tech trumps tariffs, because tech is first order, 200 basis points increase in potential growth, and everything else that is, stagflationary, that is not just tariff, reduction in migration, fiscal deficit, fiddling with independence of the Fed, fiddling with the rule of law, all the other things are second order. So I said tech trumps tariff, but also tech trumps temper tantrums too, because all those things are second order, and market discipline has forced him last year, as I exactly predicted in April, to back down. When the market was down, he was forced to do deals on trade that pushed the tariff rate from 30% to 14% and falling every day.
So Dr. Boom, the sort of gap between dystopian and utopian, pretty wide.
Yeah.
And I'm just wondering what happened to some of the political aspects of this, especially as it relates to jobs. I mean, if there is significant job loss, won't the political backlash be somewhat significant? I mean, how do you sort of dismiss the dystopian chapters in your book?
Well, I do believe that eventually we're going to get a permanent technological unemployment, but it's going to be a bit of a inverted kind of a J-curve. Initially, actually, demand for labor is going to increase because you have to build all these data centers. There'll be an investment boom, and not just in AI, across the economy. And therefore, demand for labor is going to increase. We're already at full employment. So for a few years, we're going to be actually okay. Of course, people are out of college. Those first-time jobs are in short supply and this and that. And that's becoming an issue. Longer term, absolutely. I think that by the end of this decade, growth is 4%. By 2046, by 2050, with AGI, we're at 10%. But when growth is 10%, the unemployment is going to be 80%. But it's better to be in a world where growth is 10%, unemployment is 80%, and with growth doubling every 5 years, you can redistribute, because you can tax the winners and redistribute.
In 2 minutes before the end of the show. I mean, we don't have enough time.
I tell you, that's my bet. We'll get to AGI, we'll get to SAI, and there'll be exponential growth.
Not for me to disagree. That's your forecast.
So that's right.
Let's say you're right. How does the government respond in that scenario?
Listen, we're already in a mean-tested UBI system. You know, I live in New York City. My marginal tax rate between federal, state, and local is 54. In Mandarin, might be 57. I pay real estate taxes. I pay also sales taxes. And all this progressive tax system is redistributing income to those who are rightly so left behind. Medicare, Medicaid, Social Security, unemployment benefit, disability, food stamps. So we're already in UBI de facto. We'll have to make it bigger. So in a world in which 10% of the people get most of the income and the wealth, you're going to tax them more and you're going to redistribute to everybody else for two reasons. Reason number one, if you don't do it, there is a revolution, as long as there is democracy. Reason number two, if you don't do it, there's not enough aggregate demand. A rich person cannot eat more than 3 times a day. You cannot eat 100 times. So you need enough aggregate demand. And Marx was right. Capitalism is going to destroy itself from within because of underconsumption. If the share of labor shrinks, the share of capital increases. The only way to prevent it is to redistribute from the winners to the losers. So we're already in a mean-tested UBI. We're going to make it bigger. That's what's going to happen over the next few decades. That's going to be the political solution to massive permanent unemployment. It'll be socially disruptive, but the alternative is a revolution.
Nouriel, either sounds terrifying to me. It's good to see you. Thank you, sir. Nouriel Roubini of Roubini Macro Associates. It started out so positively, and then it ended.
I brought him there. Sorry.
In a way that
Still
I didn't want to end it.
You know,
we make everybody better off.
Yeah, well, 80% unemployment. Well, either that or we're all living in a very fancy zoo.
OK, coming up on the programme, Max Kettner of HSBC, Aaron Canada Clear Harbour Asset Management, Sharmin Mossavar-Rahmani of Goldman Sachs, and Liz Thomas of SoFi. We'll see you tomorrow morning, hopefully, from New York City. This was Bloomberg Surveillance.